New York Times, and you can catch that later on Bloomberg Television. Now, coming up, hundreds of thousands of UPS workers are on the verge of a strike after union negotiations fell through. We'll talk about what that means for the company, the stock, and for the economy, the broader economy. This is Bloomberg.
Connection lost.
So Fabian, talk to me a little bit about the ocean. It covers 70% of the planet. It gives us food. It gives us jobs. It gives us, of course, oxygen. We're taking too many fish out. We're polluting it. We're making it warmer. And only 3% of it is protected. What frustrates you the most about this?
The basic frustration is our ignorance. Our ignorance about how integral ocean is to not only our well-being, but to our existence. And for far too long, we've been using the ocean as an endless resource in a garbage can. Imagine our planet is a three-dimensional system. The ocean represents 99% of our world's living space, about 3.4 billion cubic kilometers of volume, within which the vast majority of biodiversity lives and thrives. And that's what we're beholden to. That is what makes us possible as a species.
Your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance. Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg.
This is Bloomberg Markets. I'm John Oliphant with Matt Miller. Time now for our stock of the hour, and we're watching shares of UPS under some pressure. We learned that more than 300,000 workers potentially close to striking, the company failing to reach an agreement with the Teamsters, and that obviously could threaten the supply chain story if you don't get a deal reached here, Matt. We've seen in British Columbia what happens when you get striking workers at the ports out there and all the supply chain headaches, and now in the case of UPS, obviously a lot of uncertainty right now on this one as well.
Yes, they still have a month left, if I'm not mistaken. So even if talks have broken down now, I feel like it could still happen. Let's bring in Simone Foxman to talk about this. She's been covering the story for us today. Simone, so what do we know about the state of negotiations? As of now, there are no more meetings scheduled, but we're just at the beginning of July.
Yeah, and I think that people who watched this very closely knew that there was a lot of incentive for the Teamsters to kind of drag this out. They wanted to get some sort of final offer that they could put to their union members and then go return to the table when those members maybe didn't accept that deal, and therefore put the ultimate pressure on UPS to give them the best deal as possible. It's notable that some agreements have been reached on various things. For example, the companies said, yes, it will buy air-conditioned vans and start doing so in 2024.
I hope so.
I know, but look, the Teamsters want more. They think they have a lot of leverage right now, given our reliance on the package system, and that's why we do really expect them to push this as hard as they possibly can.
And Simone, I guess given there's this lingering uncertainty for the economy, and in FedEx's case, they've been cutting costs right now. I guess there's this delicate dance that UPS has to do when they're trying to anticipate what their own business is going to look like in 6 months' time.
Yeah, UPS CEO Carol Tomé, I mean, she got a lot of plaudits from Wall Street for really boosting the margins there. That was opposite the sort of FedEx strategy. But, people have gone back out to shops. They're going out and they're buying stuff rather than buying everything online, and that has obviously had an impact on all shippers. That said, UPS does ship about 24% of overall shipping in the United States, according to Pitney Bowes. So, that shipping carrier going away, FedEx, USPS, the others wouldn't necessarily be able to make up that volume, and then, yeah, you get those concerns about broader supply chain snarls.
You know that Monday was the hottest day of all time in the world, right? I would want air conditioning in my truck too.
Yeah, and I think some of this is really about sort of common sense benefits, and that's why maybe UPS has given some ground there. And then other things are just wages. I mean, wages are putting pressure on all sorts of different companies in terms of competing for talent, whether it's truck driver talent or whether it's other kinds. And their truck drivers can make $95,000 full time a year, and some even more.
All right, Simone, thanks very much. Simone Foxman covering the UPS story. We'll continue to watch this closely because it's so important, not only for the stock, for the company, for employees, but also for the broader economy, right? Because they make us such a huge part of our postal system. John, Meta right now, the owner of Facebook, trading at a 52-week high after the company is set to launch its Twitter rival. That's going to be called Threads. When does this start? It's, I think, tomorrow is the first day to launch?
Yeah, I mean, that's based on what was already in the App Store. That's the expectation, and the Bloomberg Intelligence team is already putting some numbers together on why this could be successful based on some other products that Instagram has been able to roll out, like Reels. But the tensions between Mark Zuckerberg and Elon Musk are one thing. I mentioned earlier, Matt, the other tension is that you just had the Canadian government today that said they're not going to advertise with Instagram or with Facebook because the company is basically going to be blocking news links in Canada that are provided through different media players. So you've got those two stories. How about we call them threading together at the same time here?
Yeah, absolutely. I mean, we knew this was coming. It's come in other countries, and Canada is the latest, where we're going to see no more news on the feeds unless they pay, right, the publishers for that. And Zuckerberg and Facebook, Meta have said they're not willing to make those payments. So this is going to be a bit of a standoff until it's somehow resolved.
And now you have some players in the business world here in Canada. You've had a media company based in Quebec, Quebecor, as well as a cable company in Cogeco that have said they too are not going to be advertising with Meta on its various platforms. Now we'll be hearing a little bit more from the minister in charge of all this a little bit later, actually, on BNN Bloomberg. So we'll see more on what he has to say. But yes, you have a cage match in Canada, just as we could at some point see a cage match between Mark Zuckerberg and Elon Musk.
Yeah, if there's no news and no advertising, then Facebook is just going to be our parents arguing about politics. Coming up, what about, we're going to learn a lot more about the Fed's interest rate pause last month. We're going to get the minutes, the June FOMC minutes, and we'll go through those. This is Bloomberg.
investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. Yeah. There's nothing closer than the phone in your hand.
This is Bloomberg Markets. I'm John Ehrlichman with Matt Miller. And of course, Matt, we are just a few minutes away from the Fed minutes that ultimately led to however you want to describe it. The
You're
pause,
hesitant to say pause or skip, aren't you? You don't want to get it wrong.
Can we settle on hawkish skip for now, perhaps? Let's ask Alexander Barrage, former executive at the FDIC and partner at Davis Wright Tremaine. Alexander, I'll leave it to you on the actual language, but also I'm most curious about what you're going to be looking for in these minutes.
Sure. First, thanks so much, John and Matt, for having me on. As we saw in June, as you alluded to, we saw a pause in those rate hikes, in part because I think the Fed wanted some more data on the impacts of its monetary tightening policies and more data across a longer period. Based on some recent statements we've heard from Chair Powell, however, we should expect rate hikes likely across the year. And of course, there are 4 more meetings where those rate hikes could occur. As for the minutes from the past June meeting, we can expect a few points of focus, I think, for the Fed. The first is just understanding the Fed has a dual mandate. That's the mandate of, controlling inflation and prices, as well as supporting maximum employment. So along the lines of inflation, we are not close to the 2% inflation goal that the Fed is committed to accomplishing. That said, we do see some signs of economic growth here in the U.S. Labor markets are tight, but at the same time, there's been, for the past year or so, approximately a growth of 283,000 jobs per month. So those are positive signs. Housing markets, in some respects, have weakened because of rising interest rates. At the same time, prices have come down. So whether you're a seller or a buyer, you have different things to look for. And in addition, I think one thing we'll see a lot of focus on is just credit tightening in general. A lot of the mid-sized banks are facing potential headwinds. Back in May, the Fed did a survey where banks, including banks in the mid-sized category, were reporting just some tightening of underwriting standards, taking less risks overall. So expect the Fed to be focusing on that as they issue their minutes from the June meeting.
And on that subject of the banking sector, I mean, there are those who have said, had we not seen banking turmoil earlier this year, maybe the Fed would have been actually further along in their rate hiking path. But it still bears asking the question, what is the health of the banking system right now, especially if we're going to see more rate hikes ahead?
Sure. Well, I think in general, the Fed continues to beat the drum that across the board, the banking system is safe and sound and resilient as a whole. In light of the bank failures we saw beginning in March, certainly that weighs top on the minds of bank regulators, including the Fed. And so what we may see is just an increased focus, again, on credit tightening in light of rising interest rates and the failures that we saw. One positive note note that we saw in the minutes from the May meeting was that it appears deposit outflows have largely stopped, and those deposit outflows were very limited to a certain number of banks. And so, on the positive side, it seems like outflows are under control, but bank regulators are always going to be monitoring for potential future stresses in the banking sector. So they'll be watching that credit tightening very closely.
Are they going to have sharper teeth, Alexandra? Because they were watching SVB as it plunged into failure, watching and commenting the whole time, to be fair, but that didn't really help stop the bank run. So do you expect more regulation that's going to help these regulators do their job better?
So I think that is a really interesting question. It pretty much divides. On the one hand, supervision, is that going to be stronger and more robust? Certainly Governor Bowman has made a push for that, versus more regulation to try and get at the root cause of the failures that we saw with SVB. At the end of the day, it's pretty clear that the root cause of a lot of these failures was just poor risk management. So I think it's too early to say what regs will look like on that front. But at the same token, the largest banks are very focused on Basel III, and those are what we expect to see in terms of heightened capital requirements likely to come out in the next few weeks. The largest banks are focused on that because it doesn't look like they will be a capital neutral result anymore. In fact, we expect we expect more capital requirements of these largest banks. And we may also see more banks, including banks above the $100 billion threshold, subject to potential capital regulations. So I'd say in terms of regulation, that's really where the focus is.
In terms of the Fed, there's a great debate going on between Bill Dudley and Morgan Stanley. Where will the 10-year yield go? One of the things that Dudley has pointed out is that the Fed has a new asymmetric monetary policy regime, which means that they're going to skew on the side of higher inflation since inflation was below 2% for so long. Do you think they're going to continue to allow that, or do you think they really want to bring it down to 2%?
I think the Fed has stated many times their firm commitment to getting it down to 2%. Now, the question is, when will we get there and how will we get there? I would expect the Fed to move very gradually and very cautiously in terms of future rate hikes. At the same time, we know from Chairman Powell's testimony that if the economy evolves as projected, the appropriate level of federal funds rate at the end of this year is projected to be 5.6%.
Yep.
So those are some data points, but again, a gradual approach is what I would expect here.
Alexandra, great to have you on the program. Thanks so much for joining us. Alexandra Barrage there talking to us about the Fed. We're just about to get the minutes, and we'll see the release here on Bloomberg Television. I'm Matt Miller for John Ehrlichman. This is Bloomberg.
Top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. We're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
DOJ or other authorities
could face bigger challenges next.
Fed was going to keep rate while this is a 3.
As the economic picture does.
The OK is getting ready to make this decision. This is Bloomberg Markets, The Close. I'm Scarlett Fu alongside Katie Greifeld. Romaine Bostic is off for the day. We're just moments away from the latest release of the FOMC minutes. So let's get straight to Bloomberg International Economic and Policy Correspondent Michael McKee, who is standing by at the Federal Reserve. Mike, we'll send it over to you.
These minutes may raise more questions about where the Fed was 3 weeks ago than they answer. While the decision to leave rates unchanged was unanimous, during the discussion, the committee was divided. Quote, some participants indicated that they favored raising the target range for the federal funds rate 25 basis points at this meeting, the minutes say, or that they could have supported such a proposal. Instead, there was a compromise. The minutes say almost all participants judged it appropriate or acceptable to maintain the target rate unchanged at that meeting. The idea, give them more time to assess where the economy was. Most of the participants agreed that while the labor market remained very tight, there were signs it was coming into better balance. And while inflation remained too high, the economy was slowing. Many felt that the economy still had yet to feel the impact of the cumulative tightening over the past year, and the impact of March's bank problems on credit availability was yet to be determined. At least at this meeting, quote, almost all participants noted that in their economic projections that they judged that additional increases in the federal funds rate during 2023 would be appropriate. Although their dot plot submission suggested 2 more moves, how much would depend on incoming data, a point the committee stressed. One other note, Fed staff continued to anticipate the economy would go into a mild recession later this year, followed by a moderate recovery. And also, members of the committee did discuss, although they reached no conclusions, on the impact Treasury bill selling after the deficit deal was reached would have an impact on interest rates on the short end.
And Mike, at the same time, looking through some of the details here, we see on our top live blog that Fed staff economists continue to forecast a, quote, mild recession starting later this year. That's at odds with what Jerome Powell himself has said.
That's what we have seen from the Fed staff for the past 3 or 4 meetings. Their models suggest that the economy should contract by the end of the year, but none of the members of the Open Market Committee seem to believe that, and certainly Jay Powell has argued against it, at least saying that he doesn't think it's likely.
All right, Bloomberg's international economic and policy correspondent, Mike McKee, thank you for the instant analysis and breakdown. And for more reaction to the Federal Reserve's June meeting minutes, let's bring in Claudia Sahm. She is a Bloomberg opinion contributor, founder of Sahm Consulting, and a former Federal Reserve economist. She's also the creator of the well-known recession indicator, the Sahm Rule. Claudia, it's great to have you with us. Let's dive into the debate here because, again, looking through the headlines, Fed minutes saying that some favored the hike but went along with a pause. And we know that there is some disagreements among policy members and yet no formal dissents when you look at the actual decision. What do you make of that?
It's very much like the Fed to not have dissents. I think it's a problem. If it's clear that they were having a lot of disagreement at this meeting, and that should be reflected in the vote. And but the Fed is very consensus driven. I am not surprised at all. And you said the minutes didn't really tell us much about, the consensus building. Frankly, I don't think the transcripts in 6 years are going to tell us much more. Remember, they do a lot of discussions. Jay Powell goes down to the hall and talks to so-and-so, or they pick up the phone and talk to Reserve Bank president. So this was a consensus that was built clearly with a lot of work. And it's absolutely that, and the summary of economic projections, the dot plots together, it just is like, wow, how does this make sense?
Right. So I want to follow on that idea. So these Fed officials who go along with the consensus, even though they don't necessarily agree, they, in the end, will then go out and make speeches, and we tend to follow these speeches, and they will push for what they believe in. That creates confusion in the markets, doesn't it?
Yeah, it does. And it's absolutely, after the fact, after the blackout, we start knowing who the different dots are, right? Because a Reserve Bank president can say what they voted. And, so it's, but again, I think that the summary, the dot plots is made, like this was one of those meetings where Powell was kind of fighting it. Like he could have said in a very simple way, we're going to hold where we are, we're going to keep paying attention. If we move later, that's fine. But instead he's fighting, well, almost all the dots said, to keep raising. And, it makes it hard to figure out what they're doing.
Mm-hmm. And you can see some of that confusion in the market day to day, and then also week to week and month to month as well. But let's talk about what the Fed is dealing with right now. Of course, we're counting down to the July Fed decision. It seems like the market has decided basically that we're going to get a 25 basis point hike there. When you think about what's left, we have a job report, we have another CPI print. Is there anything that we could get from those numbers that would change the needle at all?
Probably a really surprising CPI lower, right? Like if for some reason inflation came in really in a way that was favorable, maybe you let go of it. But frankly, as soon as markets have priced it in, the Fed's going to do it, right? So I think, and the idea that like June and July meetings are really close together. Like you said, they get one CPI and one employment report. How is that possibly going to change your thinking about should we raise or stay where we are? Like it's yeah, but that is the expectation that they'll hike in July. So.
Okay, and another reason why a lot of people believe that the Fed will continue hiking interest rates is you look at the yield curve. It's inverted. The 2s10s has been inverted for almost a year now. We know in the markets that signals recession. How do Fed officials, how do Fed economists look at that? Does it factor into their thinking, into their decision making at all?
So the Fed is going to bring whatever information it has. I think the financial markets are a lot of like, how is the Fed moving through these markets, right? Are we seeing the higher trade? I think that's the way that we think the most about the financials, and it certainly figures into their thinking at the FOMC meetings. Again, when we keep hearing about this staff forecast, a big piece of that is they're looking at lots of little pieces, but the big tension here is like labor market and inflation, right? And that's what they're trying to parse out.
And when we think about those two factors, just zooming out, if you think about where we've come to on the unemployment rate, down from the 14s, now below 4% on the unemployment rate, at the same time where you have inflation really steadily marching lower since the peak last June, when can we say this is a soft landing?
When inflation is down to 2% and we haven't gone into a recession, because the Fed's they're going to keep pushing this, as I think is reasonable. 2% is their target. Inflation is sticky. This is going to take a while, and they're going to keep at it even if a recession shows up this year. They really feel that they got to get this inflation down, and now, frankly, as quickly as they can.
Yeah, so they've committed to that 2% or as close to 2% as possible for now, and that remains the target so far. Claudia, really thanking you for joining us this afternoon. Claudia is the founder of SOM Consulting, and of course we'll get even more color on the FOMC minutes and markets later on when we speak with CalSTR's CIO, Chris Ailman. Now, coming up on Bloomberg Markets at close, we're looking at oil is rising as traders weigh the latest Saudi Arabian and Russian production cuts. Insight from Ellen Wald, senior fellow at the Atlantic Council. And Katie, you were here on Monday when this announcement was made, and not much of a reaction.
Not much of a reaction, and now, of course, we're sort of seeing that sort of reverse and then come back again in the market. So excited to get some insight there. We're also going to get some insight on Rivian shares higher for a 6th day as the company starts delivering electric vans for Amazon. We're going to have an exclusive interview with Rivian's CEO on those European deliveries kicking off, Scarlett.
All right, that's later on in the program. And in the meantime, energy drinks like Monster and Celsius are outpacing the wider beverage sector this year, and it's showing up in one of these companies' share prices for the last 20-odd years.
Tune in to find out which.
All that and more coming up. This is Bloomberg.
Thing in life I've often said is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy in 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like. But the more you could be you, the happier you will be.
The Fed is hoping unemployment will rise, but economists think differently.
We might see unemployment drop back from 3.7 to 3.6.
3.5, 3.7, 3.6. It is an extremely low unemployment rate.
This Friday, the surveillance team brings you the crucial jobs data and expert analysis at terminal speed.
Which movable part matters? We've had so many upside surprises.
We haven't seen the full impact of tighter monetary policies.
The Fed is going to hang tough.
The June Jobs Report, Friday on Bloomberg Television and Radio.
All right, just under 2 hours to go before the close of the trading day, and we have the S&P 500 falling for the first time in 4 days in this holiday-shortened week. We do have, of course, the jobs report on Friday that sets us up for the Fed meeting later on this month. But today's decline really needs to be seen in the context of a global move lower. This is the MSCI All-Country World Index, which includes developed and developing markets, and it's down 0.4% on a disappointing read on China's services economy, the slowest rate of growth there so far this year. We've seen movement in yields. They're a little bit mixed right now. The 10-year yield is up to 3.94%, or just about, is about a 1 percentage point below where the 2-year yield is. So that yield curve remains inverted as it has been for the past year. And NYMEX crude, interestingly, up more than 3%, a delayed reaction to the moves by Saudi Arabia and Russia to reduce production. That came out on Monday, but of course, we had a couple of days of holiday here in the U.S., so as a result, not much of a reaction until until now. All right, I was looking for some individual movers, and I came up with all-star performers here. Let's look at Meta, which is up by 3.5%. Of course, it's going to launch its own version of Twitter tomorrow at 10 a.m. Eastern Time. As Twitter has become less reliable, other entrants are coming in, and this is Meta's effort. It's going to be called Threads. Wolf is gaining as much as 23%, currently up almost 12%. It makes materials and parts for semiconductors and signed a 10-year deal with Japan's Renesas Electronics. And Finia, making its debut on the New York Stock Exchange as a spin-off of Borg Warner. It's a maker of auto parts, up 3% on the day, or I should say $3. We don't have a percentage change since it is trading for the first time. And AstraZeneca, this is the ADRs for the UK-based drug maker, biggest gainer on the NASDAQ 100. Some mixed results from its lung cancer treatment, but we saw the UK shares tumble earlier this week, and analysts are now saying perhaps buy on weakness. It's a good time, Katie, to get in.
Well, let's keep this conversation on markets going now with Jake Jolly. He is BNY Mellon Investment Management Head of Investment Analysis, joining us just 14 minutes after we got the minutes for the Fed's June meeting, which, of course, revealed some divisions, if you will, over the decision to pause in June. We know that ultimately they did, and now the debate is how many more times are they going to hike. But, Jake, what I'd love to hear from you is whether or not it matters. We know it's one, maybe two. When you're trying to construct a portfolio, though, and navigate these markets, is this the conversation that we should be having?
It matters, of course, but I think in the larger strategic allocation decisions that most investors should be focused on, rather than those sort of short-term, week-to-week, month-to-month decisions, it matters less so, right? The reality is that we've gone from essentially the zero lower bound to above 5%. Our view is that we're very near the peak in rates, although that terminal rate that the Fed is thinking where the Fed funds rate is ultimately going to end, there's still a lot of uncertainty around that. But I think our view is that that peak is near. We do think that the economy is going to soften into the second half of the year. So as the market is currently priced, you know, it's basically baked in that we're going to get another hike on July 26th. Whether we're going to see another one after that, I think it's really going to come down to whether the labor market looks the same as it does today, or I should say the labor market looks on Friday when we get the report, or whether we start to see softness, because it's ultimately going to be the Fed looking at, okay, how has inflation progressed up until that September 20th meeting, I believe, versus what the labor market looks like at that time.
So you said the economy will soften. I look at the economic surprise index, and it's been up, 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 up. It's kind of flattened out a little bit over the last couple of days. How much is priced in terms of this softening in the economy and perhaps a recession in 2024?
Yeah, I mean, that's the tough call, right? Because obviously we've had a very strong year-to-date rally, but it's in the context of a market that has been very top-heavy, right? If you look at the equal weight, the average name within the S&P 500, it's not nearly as impressive, right? And I think particularly with financials lagging, I think that the story, the headline story is not quite as, or I should say the underlying story is not quite as optimistic as the headline story has been so far. So when you look at kind of what's priced in, I would say at the top of the market, it's pretty rosy. It's a, you know, pricing in what's probably most closely aligned to a soft landing, whereas maybe underneath, sort of in the internals of the market, it's starting to price in something a little closer to reality. And I think when you look at sort of the earnings momentum, what we're expecting in sort of the coming quarters, is that it is going to be challenging, right? We think that the full impact of the tightening cycle is going to have a real impact in tighter credit conditions. And ultimately, that means that equities, being growth sensitive, are going to, we believe, face some headwinds.
And let's talk about the composition of the equity market, because as you mentioned, it's been very top heavy. What, 7 stocks have really led all of the returns. Do you see a broadening out from here, and is that enough to keep this rally going?
Well, if it did broaden out, I think it could. But unfortunately, that's not our expectation. We think that when we look at the rally year to date, if it had been paired with an improving earnings outlook, then I would be much more positive that it could continue, that the start of this bull market back in October of last year really was the true beginning. But the reality is that the beginning of this bull market came at a time that was a bit unusual relative to what we've seen historically for the start of bull markets. We had claims being very, very low. Typically, bull markets start when claims are very, very high, right? Because historically, you see the trough in the market during recessions, not before recessions. And we still see there being an elevated probability of recession in the second half of the year. So it's possible. It's certainly possible that you could have a broadening out, but we really need to start to see it in sort of a broad improvement in the leading indicators, right? Because really, the S&P is kind of the main leading indicator that looks really optimistic, whereas the vast majority of other leading indicators point to a bit of a slowdown, right?
Another catalyst for declines, I suppose, would be China. We talked about the weakness in the Chinese economy with the services data that came in a little bit disappointing, a little bit weaker than expected. Where does that show up in the U.S. equity market? Because we know the big caps are more exposed to overseas sales, the big technology companies in particular, but they've been doing just fine even with the weakness in China. And the small caps are more domestically focused, but they're the ones struggling.
Yeah, I mean, I think that has been part of the story. I think the overarching story obviously has been AI, and I think China's part of that story, but definitely more secondary. And obviously the reopening of China had a lot of optimism coming into this year, but we just didn't see that pan out, or we haven't seen it pan out so far. And also sort of the amount of stimulus that you've seen so far has really, I think, underwhelmed. So sort of those more larger structural issues with the Chinese economy are coming quicker than people expected. Kind of the thought was that, oh, it's going to be a very strong year. That's going to be, supercharged, maybe reduce the probability of a global recession. I think those bets are having to pare back, right? And really, ultimately, when we look at, we do our top-down macro analysis, it's all about looking at, okay, this year, equity market has been obviously outperforming by and large most people's expectations. Can that continue from here? Well, a lot of things are having to be downgraded right now, and one of those has been that the expectations around China growth really keeping things up has been marked down. Now, that being said, the probability of a recession in China in the near term is much, much lower. So we are generally much more positive on the Asia region, maybe not necessarily Chinese equities, but the spillover effects from China's reopening we're still relatively positive on.
Jake, really appreciate the time. Great to see you. That is Jake Jolly. He is BNY Mellon Investment Management, Head of Investment Analysis. Coming up on this program, the U.S. middle class might be deciding the presidential election in 2024. We'll dive into what's driving their decisions next. This is Bloomberg.
And money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
The U.S. middle class is feeling the pinch of stubborn inflation and rising interest rates, and so it follows that the focus is on the anxious middle class and how they feel about the economy. Proof that they'll play a huge role in the U.S. presidential election. Bloomberg's Claire Ballantyne joins us for more on today's big take story. And Claire, it's obviously the focus of Joe Biden, the incumbent right now, who's running in 2024. How's that being expressed? How is he making clear that this is his focus?
Yeah, so he said that in many speeches. We actually just had one last week in Chicago where he talked about Bidenomics, as he calls it, and about building an economy from the middle out. So this core group is really important to his base. And what we found in doing the story is that so many of them are not satisfied with the economy. They're not feeling like they're getting ahead. And some of them, at least, are blaming Biden for it.
And so middle out as opposed to top down or bottoms up. Tell us about who the middle class is, though. Scarlett and I were just talking in the break that it's sort of a shifting definition. Who are you defining as the middle class here?
Yeah, it's definitely really hard to narrow that down. And the way that we decided to go about it in doing the survey is to look at the 100 million Americans with annual incomes between $45,000 and $180,000 and wealth between $100,000 and $1 million. So there's no exact way to define it, but that's sort of a broad definition.
Yeah, and of course, depending on where you live, that range can shift quite a bit as well. You talked to a bunch of people for this story. Can you give us a sense of what the common thread is here? Because a lot of times we see the economic data and it's holding up just fine, and the consumer confidence reports seem to indicate that people feel pretty good, and certainly the spending numbers back that up. But there's this anxiety about what's to come that I think is driving this narrative you have in the story.
Yeah, I think that's the biggest takeaway from the whole story was that despite the economy doing well by many measures, like you said, all this data holding up really well, people on the ground aren't feeling that way. They're anxious about what's to come. And I think a big part of that has just been what's happened in the past year with inflation being so high, and then also the Fed tightening rates. And for everyday people, seeing the price of everything go up and their wages not keeping up with that is really scary. And, you know, for a lot of people haven't really seen inflation go down or moderate maybe as much as they had hoped. And so there's this prevailing anxiety that I think is going to take a while to work its way out, even if things do get better.
And Claire, we only have about a minute left with you, but there's a lot of great reporting in this story. Tell us about some of the people that you spoke to.
Yeah, so I tried to get a good variety. We had one man in Detroit who was a homeowner and had really tried to get ahead, but feels like everything is coming in on him. He has student loans that are coming back and expenses that are rising. I also talked to a retired police officer in Texas who's watched her retirement savings lose a quarter of their value, and then also a woman in Florida who is retired involuntarily. She was laid off from her job in the mortgage industry and couldn't get another one. So it really speaks to this prevailing sense of dread across the country.
All right, Claire, great reporting. Really appreciate it. That is Bloomberg's Claire Ballantyne talking about the state of the middle class, of course, as we head into the all-important 2024 presidential election. Before we get there, though, still ahead on this program, following the latest out of Vienna as the OPEC International Seminar kicks off, we'll be speaking with Ellen Wald, Senior Fellow at the Atlantic Council, next to talk about oil prices and the future of energy. Don't go anywhere. This is Bloomberg.
climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China, nothing comparable to that ever. That's why the heat records are broken every year, and we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority.
3 prime ministers, 4 chancellors, an energy crisis, and the soaring cost of living. It's been a hard year for startups, but even in the toughest times, some of the best ideas are born here in the UK. Bloomberg UK's Startups to Watch will profile the brightest companies under 10 years old, with the winners unveiled at the Bloomberg Technology Summit in London in October. Get your entry in by the 7th of August for the chance to have your company profiled and to attend unique networking events. Good luck, and we hope to see you there.
Back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance. Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
This is Bloomberg Markets, the close. Let's get a cross-asset check as we head towards the close of commodities markets. Bloomberg's Abigail Doolittle has more.
Well, Katie, overall, we are looking at gains. That Bloomberg Commodity Index up almost 1% or so. And as everybody, well, most of us know on the day, we do have oil popping higher at the highs up more than 3%. Its best day since June 15th. This, of course, is OPEC Plus is talking about production cuts, both Russia and Saudi Arabia, although I understand that the cuts are a little bit different in nature. Wheat, really a big gainer, up 5% at the highs, up closer to 6% at that point, heading to its best day since March of 2022. To the downside, though, most commodities are higher, but just to give a flavor for what's going to the downside, natural gas down 1.9%. I have no idea why, especially given the heat here in New York. You'd think that the AC demand is huge. Copper down 0.8%. Again, Scarlett, I'm not quite sure what is behind the weakness for copper being down either. But for the most part today, commodities are higher, even with that Bloomberg Dollar Index up just a little bit.
All right, thank you so much, Abigail. And of course, we want to focus here on oil, which, as you just showed us, is moving higher today after OPEC Plus linchpins, Saudi Arabia and Russia, announced fresh curbs on production this week. This comes as the leaders in the sector gather in Vienna for day 1 of the OPEC International Seminar. So joining us now with her insights is Ellen Wald, Senior Fellow at the Atlantic Council's Global Energy Center. Ellen, good to speak with you. I want to start with timing, because these moves from Russia and Saudi Arabia came out on Monday. There was little reaction to it at the time. Katie was working that day, and she was telling me that there was barely a blip in the market. And of course, yesterday was the 4th of July. So we're seeing a reaction today. Is this an overreaction, or is this an appropriate reaction?
I think it's probably an appropriate reaction. It's interesting because the cut from Saudi Arabia is going to be basically extending the voluntary cuts of 1 million barrels a day that they announced that they're doing in July. They're going to extend that through August. And then you also have Russia saying they're going to cut exports, not production necessarily. And I do think that whenever Russia makes an announcement like this, you have to take it with a grain of salt. And it does appear that the market is doing that because Russia never necessarily and cannot always be counted on to adhere to production cuts, especially those or export cuts, especially those that aren't done through the OPEC Plus framework.
Yeah, Russia being unreliable. What a strange thought.
I've never heard of that before, but let's zoom out a little bit just from the news that we got around production and supply on Monday, because we're still talking about Brent below $77 a barrel. I believe crude is somewhere around $71 a barrel. Of course, a far cry try from some of the levels that we saw even last summer. When you think about the oil market, the global oil market at this moment, is this a supply-driven market, a demand-driven market, or a Fed-driven market?
That's a really good question, and I do think that it is a bit of all three, and I'm glad you threw in the Fed-driven market, because I think that the Fed's decisions are also impacting Saudi Arabia's decisions, because every time they go and raise interest rates, it impacts oil demand, and so Saudi Arabia feels the need to kind of respond by having these cuts. So they're all kind of interacting with each other, but I think mostly, in fact, a lot of the market has to do with what the previous guest, Claire, was saying about sentiment and economic sentiment. And even if the numbers look good, people don't think that things are good. And there's a lot of concern amongst traders about economic weakness in China, especially, and mostly the fact that they really expected there to be surging demand this year, especially in H2, and we're not really seeing that yet. It's not materializing. And so you could almost look at this as if it's really kind of a correction from previous assumptions, and they're now kind of taking stock of, okay, this is where the market actually is. China's not recovering the same, with the same kind of boom that we thought. Things are okay, but demand's not great. There's definitely some supply issues, and I do think that OPEC is kind of reacting to this, trying to keep the floor on prices in the 70s, because that's a level that most people are fairly happy with in OPEC. Yes, they'd rather it be in the 80s, but if it goes to the 40s, that would really be in trouble.
Interesting. So these moves are really a reaction by oil-producing nations that are actually kind of bearish when it comes to the demand picture globally. I want to go back to what you were saying about Russia. How much do you trust Russia to follow through on what it signals, given the possibility of instability at the top of the government? If there's a real threat to Putin's leadership, anything could happen, and he might need to pull some levers unexpectedly.
Exactly, and I'm not a Russian tea leaf reader, but clearly it's important for them to have this oil revenue. Now, we know that Russia is happy selling crude oil at lower prices, and that they're making up money on the other oil kind of services that they're selling, like shipping and insurance and things like that. But I do think that if they get to a point where they really need money, there's always exports. They can try to sell more to India, more to China, more to Malaysia, more to Turkey, more to Indonesia. There are plenty of places that are hungry for Russian oil to process it and sell those products around the world. The question is whether this export move is really going to bring gasoline prices down in Russia, because they may need to funnel more crude oil domestically into their own products, and that may be a way of kind of satisfying some kind of internal domestic demand issue.
All right, reading the tea leaves there in Russia, always a challenge. Ellen, thank you so much for joining us today. Ellen Wald is a senior fellow at the Atlantic Council. Coming up on Bloomberg Markets at Close, we're looking at Rivian, which is rolling out its first shipment of Amazon electric delivery vans outside of the U.S. to Europe. More on why this and other attractive factors prompted an upgrade at D.A. Davidson. We're going to be speaking with Michael Schlisky next. This is Bloomberg Markets at Close.
Names in business are on Bloomberg.
For Indigo, this is a 500 planes order. That's the biggest order ever in terms of number of planes. It doesn't change the short-term perspective on ramping up the production.
All our aircraft deliveries are delayed. The supply chain that was really decimated during COVID.
It's a real challenge for all the OEMs at the moment, but we absolutely have to have those aircraft delivered on time.
Nobody covers business like Bloomberg, your global business authority.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
City. From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening. Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
Time now for top calls. A look at some of the big movers on the back of analyst recommendations. And we start off with Conagra Brands. Jefferies downgrading the packaged good companies with brands like Slim Jims, and Duncan Hines to hold from buy. The analyst cites concerns about its near-term volume growth and says that margin expansion alone won't be enough to generate investor appetite. You can see shares off by about 1.5% at the moment. Next up, we have Netflix upgraded to neutral from sell at Goldman Sachs. The price target raised to $400, up from a street low of $230. The analyst giving props to management for its execution of the password sharing crackdown and expects that Netflix to see continued positive momentum into the next 2 years. Shares up just a hair, up 0.9% or so. And finally, we have Rivian, the EV maker, upgraded to neutral from underperform at D.A. Davidson. The price target raised to $18. Of course, this comes as Rivian starts shipments of its Amazon delivery vans to parts of Europe. And while there are other positive factors to consider, analyst Michael Schliske is cautious to recommend a buy rating as Rivian, of course, faces other challenges. You look at shares, though, up by about 1.6%. Scarlett, those are some of your top calls.
All right, Katie, let's continue the Rivian conversation with the analyst behind that call, Michael Schliske, D.A. Davidson Managing Director, joins us now. Michael, good to speak with you. Katie was telling us about the Rivian starting shipments into Europe. This was not unexpected, as you write in your note, but you are encouraged by the fact that it's happening sooner rather than later. Is this an instance where Rivian under-promises and over-delivers, or is this production just on a faster timeline than many had anticipated?
Yes, Teddy, thanks. I would say actually it was probably the former. They probably weren't ready to say with any certainty back when we last heard from them on the last earnings call that they were ready to ship to Europe. They had all the approvals and all the other logistics in place to make that happen. But now that it is ready, apparently through their partnership with Amazon, it does seem like they are ready to kind of over-deliver on that kind of promise. Absolutely.
And you see a lot of that good news in the price. Rivian on track for a 6th day of gains. But why not yet a buy rating, Michael? What keeps you cautious here?
Yeah, I mean, look, this upgrade today was based on a change in the headlines turning a lot more positive over the last month or so. But some of those negative headlines are still there and possible risks are still there. A few of them include the ramp up of production on schedule and kind of meeting their full year guidance. There are a few changeovers in suppliers that have to take place across seats, wheels, etc., that they have not completed yet. There's always some disruption issues there that could take place. And then interest rates and the broader economy. Could consumers opt for lower priced EVs or other kinds of vehicles as opposed to their relatively high priced SUV and pickup truck version?
Okay, so I want to continue on that in that vein, higher interest rates, because we pretty much know that the Fed is going to raise rates. Well, they've said 2 more times, possibly by 25 basis points each. Walk us through a little bit more what higher rates would mean for a company like Rivian.
Well, there's a potential that having to get a loan to get a car might be challenging to obtain if it's a higher interest rate. It's as simple as that. It's just going to raise your monthly cash outlay if you're a consumer. On the other hand, because it's a high-priced, higher-end vehicle in most cases, a lot of the consumers that are buying one can afford to buy one with cash, and so hopefully it won't be that much of a headwind. But simply, high monthly payments is kind of all that higher interest rates means right now for the auto consumer.
And Michael, I want to get your thoughts on the partnership with Amazon. Of course, Amazon is the biggest shareholder and the biggest customer to Rivian. Is there a form of key man risks there, if you will?
There is. If Amazon were to opt to take its shares or sell the shares, certainly that could cause a headwind to the stock price, even if there's no dilution involved. We saw other companies in the mobility space over the last few weeks sell shares from one holder to another, one large holder to another, and that unfortunately did result in some share price downside, even though there were no new shares being offered. That would certainly happen here. In addition, because they're such a large buyer of the vehicles, if they were to kind of back out in any way, that kind of headline would be one of the other risks we would see as well for the shares.
All right, Michael, really thrilled that you could join us today. Of course, that is Michael Schliske, Managing Director of Equity Research over at D.A. Davidson. Coming up, we'll be joined by Stephen Englander, Standard Chartered Bank Head of North America Macro Strategy, to discuss the reliability of U.S. payroll data and how it stacks up to other metrics. That's next. This is Bloomberg.
Thing in life I've often said is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy in 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like. But the more you could be you, the happier you will be.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
Just about an hour and 15 minutes to go before the close. It's time now for our Wall Street Week daily segment, and host of that segment and host of Wall Street Week, David Weston, joins us now. David, it's a big week, even though it's a holiday shortened week.
Yeah, and a big Fed week. We got the minutes to this afternoon, and then we're going to get payroll data coming out on Friday. And as you know, we really are all focused on that because of what it tells the Fed about what it should do about rates, right? There's a question, though, about how reliable those data are.
You're going to go there.
Yeah, exactly. Well, somebody who's raised the question is Stephen Englander. He's Standard Chartered Bank Head of North America Macro Strategy. Stephen, great to have you with us. Thank you so much. We picked up your name as one of the people who's really raising questions on the data. And I guess my basic question is, what is the risk of a policy error from the Fed because they are getting data that may be too rosy on the job market?
Well, the risk is certainly higher than it was a few years ago because there are question marks about the sample. The response rate is a lot lower than it was pre-COVID. Now it's down to below 45%. And there's also this puzzle that they have a comprehensive measure of what the labor market is doing called the QCEW, Quarterly Census of Employment and Wages, that they have on a monthly basis, even though it lags by about 5 months. But they only use 1 month of that comprehensive number every year to update it. So in between, we're kind of using numbers that we know are inferior. And, just to finish off, the last QCEW that we have, which is for Q4, suggested that the level of employment growth in Q4 was probably quite a bit lower than what NFP was showing.
Okay, so none of these developments are encouraging. I want to go back to the response rate to the household survey in the monthly jobs report. Obviously, the Fed relies on more than just one source when it comes to the job market, to the labor market. Are other sources of labor data therefore gaining in importance and in reliability for Fed officials and anyone else who's assessing the direction of the economy?
Well, I think that for 40 years, markets have moved on payrolls. And, we do have better measures, even though they're lagged. The one measure that's kind of risen in importance, which is JOLTS, is based on about 20,000 establishments it has like a 32% response rate. So the question of, do you really believe the numbers that it generates? I think it should be prime. And a lot of, basic question is, do these numbers tell us what they're supposed to tell us? Mm-hmm. For example, the JOLTS numbers have an implied check on the non-farm payrolls. Even though they're a smaller sample, you can obtain a measure of what employment growth was. But the BLS doesn't discuss it. They forced the two through a mechanical procedure to be the same. And the question is, if you have two samples that are ostensibly measuring the same thing and they're showing something different, you force them to be the same. Are you kind of hiding the fact that the samples are telling you something that, may be contradictory?
So, Stephen, there's a sample issue that I guess we would have no matter what's going on with the economy overall. Is all of this made more risky when, in fact, the economy may be going through a transition? And particularly, I've read now about the death rate, not of people, but of companies, and then maybe there's more vulnerability because of that, because of startups, whether they are coming online or not.
I think that is the case, that there's probably a cyclicality to firm closings, that, when the economy is slowing down, more firms close and fewer new firms start up. And that's probably not well captured in the birth-death adjustment. And again, that's something that we'll find out in August, because the QCEW, when it comes out, will tell us, what total job creation was. And kind of unlike NFP, which has to guess at the birth-death, if firms close, they're not in QCEW. If they open, as soon as you start paying your payroll taxes, you're in QCEW.
Clearly, at the end of the day, jobs data is lagging, and this is something we always say, that you have to take it with a grain of salt. What do you suspect is happening underneath the solid jobs numbers and the solid evidence of the labor market that we have right now that you think will become a big deal in 6 months' time and a year's time?
Well, if the labor market was as tight as, these numbers suggest it is, my wages should be 40% higher. And what you see is everybody's real wages are falling. I mean, that's kind of the indication that we've had throughout this, period where, jolts and to some degree the payroll data are suggesting that things are very tight. The question is, if it's so tight, why isn't that reflected in what people are getting paid? And my suspicion is that it's not quite as tight as these numbers suggest they are.
So, Stephen, I'm curious. I'm not a statistician, but my sense is whenever you have data based on samples, there's some risk. There's some upside and downside. If I'm the Fed, do I think basically the upside risk is symmetrical with the downside risk on the jobs numbers? And to say maybe the jobs numbers are better than we know?
It's possible. The issue is this, that say you want to have a sample of 100, instead you have a sample of 80, but both are good random samples, you're not going to lose much. If it turns out that the 20 people who are not in the sample that you expected to be there have some characteristic that skews the sample, you really don't know. Q4 was a lot weaker than what NFP was saying. That suggests that the risk is to the downside.
We know investors take their cue from jobs data, whether it's NFP or the JOLTS data. What is your understanding of how companies use this data and refract their decisions through it?
I think they largely reflect through the market. And to be honest, you talk about QCW, you might as well be talking about the Roman Empire with, with many people, because just because it's so aged, and yet, there's messages or information you can extract from it. And certainly, one piece of information is to say, don't kind of tie yourself to the mast that, 1 month's NFP data or 2 months NFP data are telling you God's truth, because as I said, I think the data quality has been declining, and there's room for an examination of whether or not they're actually telling us what we think they are.
So, Stephen, you're head of North America macro strategy. Give us some macro strategy here. Given all the risks you've identified, what should the Fed be doing? It isn't just 1 month, of course. We've had quite a few months in a row where the jobs numbers are coming in substantially above what was expected.
Well, they're coming above, and yet if you look at the latest numbers on inflation, they're coming below. Some of the numbers on the economy has clearly slowed. Even the NFP numbers, such as we have them, are on a downward trend. You take any kind of engineering course, any kind of stats course on how to deal with uncertainty, the answer is you take smaller, slower steps until you think you have clarity, not bigger steps. And I think that there was a good case for slowing in June, and I think there's actually a good case for pausing, skipping June. There's a good case for skipping July. But if it turns out that the economy is strong, go back to doing 25 or even 50 in September. But don't be so kind of eager to raise rates when you're so unsure about where the economy is. That being said, they've made so many statements pointing to a hike in July. We now expect them to hike in July along with the rest of the market.
Stephen, thank you so much for being with us today. Stephen Englander, he is Standard Chartered Bank, head of North America Macro Strategy. And as I listened to Stephen, it may make some sense what we saw in the minutes today, that they weren't all uniform, actually. And what they did, there's some indecision there.
Yeah, but I find it curious that the Fed insists on presenting this unanimous front when they announce their decision. It's okay to have dissent. As Stephen said, there's a lot of uncertainty. Why hide it?
It's healthy.
Yeah, I mean, the Bank of England's okay with it. Why isn't the Fed?
I'd be worried if they didn't have dissent. So tomorrow we're going to hear, believe it or not, from Tom Barrack. Remember him, the founder of Colony Capital, about exactly what it is investing in the Gulf and why he got in trouble for it. And on Friday, we're going to be joined by special contributor Larry Summers on the jobs numbers. That will be Friday at 6 p.m. Eastern Time.
All right, plenty to look forward to. Holiday shortened week, but lots of data for us to get our heads around.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenivek on Bloomberg Radio.
Matt Miller here, in for Tim Stenivek for the summer, and Carol Masser is out as well today.
She is.
I guess taking some well-deserved rest after broadcasting live from the Boston Pops for a few nights in a row. It was a long weekend for most. A lot of people took Monday off. Jess Menton joins me right now in the Bloomberg Interactive Broker Studio. Jess, did you have a 4-day weekend?
I was here on Monday.
Oh, you were here on Monday.
Okay. Filling it, Paul T. Sweeney was on break for he has his compound down on the shore in Jersey.
So I was
Sweeney filling
compound.
in. Maddie and I were filling in Madison Mills.
So, what did you see in markets? I mean, we had an incredible run-up at the end of last week to about 44.50 on the S&P 500, and we're still hovering right around there.
We definitely are. There wasn't too much, not surprisingly, going on Monday. Volume was down. If you look at the AVAT in the terminal, one of my favorite functions, but if you looked over the past month, I mean, volume was down about 20% on Monday. And then if you're seeing today, I mean, things kind of, looking at what's happening with the communication services and versus some of the other decliners, kind of offsetting those gains today. But it was very quiet coming into this week, Matt.
Yeah, not a lot going on in terms of markets. We did have a lot going on in terms of America, right? You had problems with airlines that we're going to talk about, a lot of cancellations, a lot of ruined vacations, and we have a lot going on in terms of politics as well. We're going to talk to a couple of reporters. Sean Donnan joins us to talk about how the U.S. middle class is reacting to the changes in the economy and how that'll affect the upcoming election. And then Josh Green joins us as well, our national correspondent, to talk about the Democratic fight over student loan forgiveness, which we heard the answer to at the end of last week. There won't be any, at least for now.
And also looking at what that means, especially when those payments start to become due. They accrue interest in August and then start having to be paid in October.
All right, so we'll talk about all that. Right now, let's get over to our colleagues in TV. We're joined by Scarlett Fu and Katie Greifeld for the simulcast.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. We've got 60 minutes left in the trading session. I'm Scarlett Fu, along with Katie Greifeld, and we are joined now by our colleagues, Jess Menton and Matt Miller at Bloomberg Radio. We together welcome all of our Bloomberg audiences across TV, radio, YouTube, and those streaming on Bloomberg Originals. And Jess and Matt, it's too bad Carol's not here, because if she were here, my guess is she would want to talk about China, given the data we got out of China.
Definitely, and what an honor to fill in for the Carol Masser today. I'm sure she's enjoying her time, probably potentially on a boat somewhere. But looking at these markets, I mean, I was here on Monday, and just the volume, not surprisingly, right, when you're coming into a week like this, is going to be a lot lower, just given the holiday, right, Matt?
Yeah, absolutely. Volume will be down, but it's surprising to me that we continue to see this strength in the S&P 500. I mean, 4450 is still, as you all know, well above strategists' forecasts for the S&P at year end. I think right now we're still at 4,091. So we're a solid 350 points above that. And I guess it will have to come down a little bit if we're to meet strategists' expectations.
And looking at what's the gainers in the S&P 500 today, looking at what's happening with communication services type stocks, those are leading the way when you're looking at what's moving things up. But also, if you want to look at more individual type names, looking at what's happening with Meta as well as Google, seeing some upgrades there when it comes to Alphabet stock. But then when it comes to Meta, it's supposed to roll out a bit of a rival type platform when it comes to Twitter. But you're seeing those two names leading gains in that particular industry group in the S&P 500.
All right, very much looking forward to seeing how that does. I know Carol and Katie will still be addicted to Twitter regardless. I want to talk about...
I signed up for Blue Sky. I will put that out there.
Yeah, it'll be... I'm gonna be watching you, Katie, to see how you react to this new service.
Are you gonna put cats on there? Do I want the same brand on Blue Sky? Should I be someone different?
It's a pretty good brand.
Yeah, we'll see. Anyway,
it's
Matt,
an
what's that chart?
opportunity to reinvent yourself, just like earnings season. Is that a good seg?
It definitely is.
Take a look at the revisions that we've seen heading into earnings season. I guess it kicks off in earnest next week, right? And
it is with J.P. Morgan on July 14th.
Oh my God.
Absolutely. On Bastille Day, we'll find out how it starts. You can see that the revisions have been down. These are for major regions, they say. So we see revisions for global earnings, revisions for European earnings, ex-Great Britain, of course, and revisions for U.S. earnings. They tipped a little bit higher after first quarter earnings were out, and now they're coming back down. We now expect earnings to go down, to contract more than 8% in the second quarter. But of course, we expected an 8% drop in first quarter earnings as well, and only saw a drop of about 3%. So maybe we'll have the same kind of cut and beat.
Yeah, I'm looking at that chart, and the director just told me it matches my dress, so I don't know what that says. In any case, I'm looking at the markets right now, and modest losses to start the week off here. You're looking at the Russell 2000 lagging behind everyone else. What else is new? And of course, the NASDAQ holding up a little bit better in that it's mainly unchanged versus the S&P 500, still holding at 4450. So if you were to close out the year at this level, there would be a lot of people who would be pretty happy with the gains that they booked in 2023 so far.
You know, Scarlett, it's funny because that board kind of matches my dress, which is more pink than red, but still, let's go with that. Let's take a look at some of the sectors, though. This is interesting because we were just talking about, you know, obviously it's a down day in markets. If you take a look at what's doing well, it's utilities. That's pretty defensive. Utilities up about 1.8%. Also seeing some love for communications services, up about 1.5%. Real estate, too, up about 0.9%. So 3 in the green, 8 in the red. You take a look at the bottom of the list. Materials off by about 2.4%. That is your biggest loser today, Scarlett.
Yeah, I think the materials are tied to that China story with services coming in weaker than expected. Of course, that means less demand for all kinds of materials that China would then turn into goods. So let's take a look at some movers. I don't know how this ended up this way, but they're all gainers for some reason. Wolfspeed, I just included, up almost 13% after signing a 10-year deal to supply materials for semiconductors to Japan's Renesas Electronics. We're also looking at Finia, which is making its trading debut. It's a company that makes fuel systems for cars. Matt, do you know this company? Sounds like something you would know.
I have not heard of it until I read the stories about it today. So no, I didn't know.
Okay, well, that's a big car head, so I would expect that he would normally know this. And of course, AstraZeneca moving up about 3%. Analysts are saying the stock weakness earlier this week presents a buying opportunity after some mixed results from its lung cancer treatment trial. Also, of course, big picture on a macro basis, let's take a look at this because it's been the case for the past year. Investors have been anticipating a U.S. recession for almost a year now because of this inverted yield curve. Shorter duration debt yielding more than those with longer maturities. This is the 2s10 spread, and you can see at the bottom there how long the 2s10s has been inverted, 260 days now, the longest since going back to the early 1980s, which Matt and I can remember those days. I don't know if Katie and Jess can.
I don't think Katie and Jess were around yet. You know, the interesting thing is that we focus on the 2s10 so much, but Powell has said in his pressers that he looks at the 3-month 10-year spread rather than the 2s10s to signal whether a recession is coming, and that's inverted as well. So wherever you look, the bond market is telling us we're having a recession in the next 12 months.
I'm happy that all the curves are on the same page because I got to say it's a lot easier to call up the 2-year, 10-year spread on your terminal than it is the 3-month, 10-year spread. But maybe that's a me thing. But again, they're all sort of sending the same message. And 2s10s in particular been inverted for a year. At what point do we say maybe this wasn't a recession signal this time around? I guess we have, what, 6 more months?
Yeah, well, the Fed is signaling it's going to raise interest rates the next 2 times. So that accounts for why the shorter duration debt is yielding more. The big question is whether this is a useful signaling tool anymore when everyone expects it to signal recession.
Yeah, well, I mean, I think that the 3s tens is more useful, and by that I mean 3 months, 10 year. You can find that, by the way, by typing WB and then clicking on the United States and then clicking on curves, and then you can scroll down. Did I lose you already?
Yeah, no.
We're inverted by 139 basis points, so it's pretty massive. As Katie, you well know, by all of the flows into the short end that we watch on ETF IQ every week.
Some of them starting to come out, though. You know, if you think about just how hot that bid for cash was, maybe starting to ebb a little bit here, especially if you also look at the money market funds. The hottest trade in bonds, maybe it's starting to cool.
All right, well, we'll continue this conversation in an hour because that does it for now. We'll be back together again live on television, radio, as well as YouTube, and a number of other streaming services at 4 p.m. Our Beyond the Bell coverage kicks off again, or we resume it, I should say. We'll take you through today's market close. Heck of a lot going on in markets, at least if you look at just the benchmark index, Jess. We don't see a big move. You don't see a lot of volume. Obviously, it's a shortened trading week, but I'm still struck by the level that we've reached on the S&P 500. 4450 essentially is where we're trading. And as we were talking about before, we're still well ahead of the strategist forecast for year end.
Yeah, right below 4100. So it's about 4092. If you look at Lou Wang's table that she puts together on the cross asset team, always right. It's amazing. So if you look at that, so still a little bit higher than the 4,000 mark that strategists were thinking coming into this year, but still obviously well below where the S&P 500 is trading at right now.
All right, so let's talk about the drivers of this. Molly Smith joins us right now, economics editor. She's in the Bloomberg Interactive Broker studio with us, and we have Emily Grafeo as well, cross-asset reporter from Bloomberg News, here to make the foursome. What do you see as the economic impetus behind this gain? I mean, people always say Wall Street and the Main Street economy are disconnected, but it does seem like the economy is still fairly strong. We haven't gone into a recession yet that we know of, and the market is just plugging along.
Yeah, I mean, as far as any catalyst today, really was just the minutes that came out about an hour ago, and which kind of took me a little bit by surprise. Definitely showed there was a lot more division going on in last month's Fed meeting than what initially met the eye. Remember, that decision was unanimous to hold rates, but I think it took a little bit more swaying from some of the hawks on the committee to be on board with that decision. So I think a lot of people are now looking ahead to the jobs report that we've got coming this week and other data that the labor market's still really strong. So that's probably how Main Street feels about the economy right now.
All right, so we're always looking ahead to the next data point on EcoGo. We're also looking ahead to earnings next week, and beyond that, Emily, I don't see much more than like the S&P, the 10-year, and the price of Bitcoin. Give us the cross-asset perspective.
Well, the cross-asset perspective is we have rates moving up higher every day. We have these Fed minutes that come out that kind of reiterate this idea of a central bank that wants to go higher for longer, and yet the equity market has been very resilient, and that's caught everyone off guard when you look about the strategists that Jess mentioned, but also portfolio managers that I have been interviewing all year, heading into the year, staying in cash, staying defensively positioned, low vol, and we're seeing that the broader market is outperforming that.
So Molly, when you're looking at the Fed minutes, and not surprisingly, the disconnect and the divergence between members at the Fed, and we already got the dot plots, obviously, when we had the Fed's meeting 3 weeks ago. So, I mean, was it really a surprise? Did we get anything new from the minutes?
No, definitely nothing new per se. I think maybe it was just more of like a, kind of like to see like how there was like a, the language of like, this is what the people who would have supported a hike were thinking. Right. And to me, it kind of was, it made me think, Was the dot plot then the concession to get them to be on board so that we preserve this, unanimous decision here? Because that really has been a bit of a strong point of Powell's tenure here, that like he has had a lot of unity on the board, and something that he would probably look to as a point of success as in his time as chair. So I think that might have maybe been what the Hawks needed to be convinced that like, okay, we'll stay on hold, but as long as you show that we're going to keep going.
Well, and others seem done already, right? Every time we hear Raphael Bostic speak, it seems like
the newest dove.
The dove
where'd he
we
come
love,
from?
right? He doesn't want to see any more rate hikes because he thinks inflation is coming down, and that's going to provide passive tightening, I think is the way he puts it. I don't
Which
know.
kind of is happening, to his point, to Goolsby's point, another dove who's been, more consistently a dove at least. And we have seen inflation coming down slowly but surely. Granted, I think a lot of what the Hawks will tell you is that so much of that has been an energy story, and that if you look at some of the other, trimmed mean measures of inflation, or those core services ex housing, the super core, all the other ways they like to slice and dice it, that there is still, underlying inflation is still very robust. So I think there's really something for everybody in this economy right now, however you want to paint it.
So Emily, whenever you're speaking with portfolio managers, how are they positioning?
Well, so the defensive, it continues to catch me off guard, because you'd think that people have switched now to not being so defensive in their portfolios just after we've been caught so off guard by these equity market gains. But I do still hear a lot of people in cash adding that 5% yield. They want to get that, and that's actually more rewarding on a risk-reward basis than maybe taking the risk with going into
Really? So like
equities.
instead of double-digit gains in the S&P 500,
yeah, just take that safe, risk-free rate.
What is the biggest risk? I mean, is it just they're still concerned about a recession?
Still concerned about a recession. I just got off the phone with a hedge fund manager. He does long short. He actually has been trimming his technology stocks, and he cited valuations and again that risk of recession, but he was kind of an outlier. I still do feel
how
people
does
are defensive.
That square away with, say, portfolio managers who most likely would have like a bit of a longer time horizon there?
Mm-hmm. Well, stocks only go up in the long term.
That's what they always want to say, right?
That's what they always want to say. Yeah.
Right. So they're probably a bit different than, say, a shorter time horizon than hedge fund managers.
Especially on a tactical basis.
Right.
I think a lot of people are just looking at the gains that we've had in the NASDAQ 100 and thinking, all right, this has to crack at some point. We can't just go up forever. But on a longer term basis, a lot of those tech names, they have really strong balance sheets. They have strong cash flow. They have products that people want to buy. Maybe not the Apple VR headset. I don't know if I'm getting in line to buy that. But on a more broader basis, I mean, iPhones, using Instagram
It is
Reels.
amazing that we've had these tech stocks continue to rally regardless of the rise in rates, right? Didn't we all think
Same
that
with the
these
job
were
market.
long duration
Yes.
stocks that when rates rise, they're going to have to take a hit? That hasn't happened. I guess it's the mega cap stocks that have really helped us. In terms of the job market, we saw a wave of layoffs that seem to have ebbed, right? I mean, I think it peaked around January or February, and we've gotten fewer and fewer headlines about big tech companies firing people.
Totally. I mean, I think they kind of, a lot of those plans also were outlined late last year into early this year. So granted, a lot of those were really just announcements when we saw the headlines. So the actual laying off of workers when they come off the payrolls, that perhaps may not have happened yet. That could maybe take another 3 months after those headlines come out. But by and large, the labor market is still incredibly tight. Fed officials said as much in the minutes that just came out about an hour ago. So that really is the chief concern right now when you're trying to get inflation down to target.
So Jobs Day on Friday. Can you give us a preview?
Yeah. No, it looks like we're going to have another pretty strong day of, this has really been the jobs market of the last year-ish now of that, payrolls growth has been slower, but still very strong.
Right.
You get a consensus right now calling for a 225.
I'm looking at Whisper. 225 is exactly the survey number.
Yes.
The Whisper is 261.
Ooh.
So do you guys play
I would always take the
WHIS
upside.
Go? You can put in your own bet, and I don't know if you're allowed to. Are you?
That would probably be some form of insider trading, which we have no knowledge of. I will say that. I have no idea what it's going to say, but as Emily and I were talking about on radio earlier today, it's been 14 straight months now that the payrolls print has come in above expectations. So when in doubt, I'd take the up.
Yeah, betting on the upside is definitely less risky.
Yeah.
It's interesting that we're at such a low level of joblessness, and yet we're still so worried about recession. Where do you see recession fears cropping up the most? Oil actually rebounded to above $70 a barrel, which is, I guess, a good thing. But it's been hovering down below that for so long. It seems like the energy market is discounting a recession already.
Yeah, I mean, when we see small caps, we saw another leg lower in the Russell 2000 today, at least off of those minutes. I mean, we're still positive for the year. Russell 2000 up 6%, but of course that's underperforming the S&P's nearly 16% gain. So I have heard a few sources point to that and say, well, not every stock is up. Take a look at these cyclically sensitive stocks like small caps, and those are down.
I always like to look at the copper to gold ratio. It's actually pointing a bit higher, but had fallen earlier this year.
That's such a good cross-asset.
So how much
signal.
copper can you buy for 1 ounce of gold? Is it, I mean, that's a lot of copper, right?
Definitely is, but obviously the barometer of what it says about the global economy when it comes to copper. But
right, and copper is more useful in our future maybe than gold in terms of, the electrification of everything. All right, fantastic panel. Thanks so much, both of you, for joining us. Emily Grafeo is a cross-asset reporter, and Molly Smith covers the economy for us. We're still looking at equity markets that are off a little bit, and I stress that. The S&P 500 is only down by 4 points right now at 44.51. The Dow Jones Industrial Average down by 100, but at 34,318. Even it's had a good year, and the Nasdaq currently down about 5.5 points at 13,811. We're going to talk about the economy and its effects on the election next. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 3:21 on Wall Street. Stocks are trading lower. We do check markets all day long at Bloomberg. S&P down 4 points now at 44.51, a drop of 0.1%. We've got the Dow lower by 103 points, down 0.3%. The Nasdaq Composite Index, little change now, down 3 points, down less than 0.1%. The Nasdaq 100 Index up 16 points, up now by 0.1%. Most stocks so lower after meeting minutes from the Federal Reserve today. Traders are now sifting through all that commentary to try to gauge what action the central bank will take later on this month. 10-year yield 3.93% with a 2-year 4.94%. Gold at $19.16 the ounce. Spot gold down 0.5%. And West Texas Intermediate crude 72 even a barrel, up right now by 3.2%. So the S&P, little change, down about 0.1%. Kara Murphy is Chief Investment Officer at Kestra Investment Management, and she told Bloomberg Markets earlier today she would like to see a broadening of this rally.
Yes, we're starting to see better improvement in the small cap companies, but there has been some justification for this very concentrated market. Now, for it to continue to be healthy, we have to see it broaden out, right? We can't forever be reliant on just a handful of companies. So I think in order to sustain this rally, you need to start to have small caps participate.
And you can hear more of that conversation on the Bloomberg Markets podcast. You can download it wherever you get your podcasts. More than 300,000 UPS workers are closer to striking after the company failed to reach an agreement with the International Brotherhood of Teamsters. UPS shares, they're down 2.1%. Rival FedEx up by 0.2%. Again, recapping, stocks lower, S&P down 0.1%. 2-year yield 4.94%, the 10-year 3.93%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thanks very much. Charlie Pellet there with the Bloomberg Business Flash. I'm Matt Miller here in the Interactive Broker Studio with Jess Menton. We're filling in for Carol and Tim today. And I want to talk about the big take story. President Biden obviously aiming for re-election in 2024, and it's key to him that he gets America's 100 million middle-class voters on board. He's got to convince them that the economy is better, not just make the economy better, right? It's all about perception. And that is today's big take story. Sean Donnan wrote it, senior economics reporter out of Washington, D.C., joining us now on Zoom. Sean, excellent story. You interviewed, I think, 24 people in the middle class, which I guess we define as what? How do we define the middle class?
Yeah, look, we can have a long debate about how we define the middle class in America, and that's been the case for many years. But for the sake of this story, we looked at both income and wealth. And on the income side, we looked at income between $45,000 and $180,000 per person. And on the wealth side, it's somewhere between $100,000 in assets and $1 million in assets. We think that's a pretty fair set of boundaries for what most people would consider middle class in America today.
Absolutely. We don't have to debate it. I mean, for the purposes of the story, you laid it out really well, and you talked to a number of people who seem to me really worried about the economy, which is interesting because you can include a chart also that shows the increase in wealth since the pandemic. It's been absolutely tremendous. I think more than $6 trillion in total for the middle class, even including the $2 trillion in excess savings that have been spent off in the last year. So why do you think people are still so bearish?
Well, I think it's because they're looking at a number of different things. And we didn't just talk to 24 people. We also put a poll in the field, working with the Harris poll, in which we talked to several thousand people in the middle class for. And what we found is that if you ask them what emotions they see most in when they think of, or they think of most when they think about the economy, they list anxiety and stress. That's partly because they're looking at that hit to their net wealth, and it isn't just excess savings that we're talking about there. It's the impact on 401ks and retirement accounts. It's the impact on housing prices that we've seen. We see that in the Fed's distributed financial accounts data. It's also the way their household budgets have been kind of reordered by inflation. I think, inflation is slowing down, but people know that they're paying more for everything from property taxes to vehicle maintenance than they were before the pandemic, and that those things aren't going away. So there's a squeeze there that people feel in the middle class. And then there's also anxiety about the impact of higher interest rates, right? If you are sending a kid off to college in the fall and you're taking out a parent's student loan, you are going to be paying an 8% interest rate. If you are buying a car, you're paying a higher interest rate than you were. The cost of servicing credit card debt, the cost of a mortgage were you to move from a house that you own now and into a new mortgage would be much higher than it was beforehand. People are looking out at, absolutely, they see the economy being resilient. They see they're hanging on to their jobs for now, by and large. But the fact is that people are feeling squeezed and they're anxious about what lies ahead.
So, Sean, how does this end up setting the stage for the election next year?
Well, if you think about what President Biden was doing last week in particular, they really ramped it up. The sales pitch is that the economy is going great and that Bidenomics in particular has benefited the American middle class. That may be true in the future. There clearly is a surge in investment in manufacturing that will lead to new jobs down the line. There clearly is a lot of investment happening at home that wasn't happening previously that will help the middle class in the future. But right now, the middle class is still having a hard time. And that makes the sales pitch from the president a little bit harder for folks in the middle class to absorb. It also means that it gives ammunition to his Republican opponents, whether it's Ron DeSantis or Donald Trump next year or someone else who will undoubtedly latch on to this.
Is it difficult to explain kind of quantitative advances and math to a demographic that would prefer to vote on feelings rather than pay attention to the data?
Well, I don't think they are just voting on feelings. I think they are looking at the data over the last year versus the data from before the pandemic. And there's no doubt that on the wealth side, for example, things turned when the Federal Reserve started raising interest rates in March of 2022. There's a very different reality today than there was then, which of course was better than it was before the pandemic. But people, have shorter memories than many economists.
Well, I just was thinking about the labor market. A couple of the people, you happened to find a few people that were laid off, right? But we have the lowest level of joblessness that we've had since the 1960s here. And excess savings, if you graph it, are still much higher than they were before the pandemic. So it seems like everyone has a job, and obviously I'm generalizing because each individual is different, but it seems like everyone has a job and bank accounts are still full.
Yeah, look, I mean, it's the data is the data, and the aggregate data often tells a very different story from what people are feeling at home. And I think that's the reality. I think, there is data there that points to a real squeeze on the American middle class. And yeah, we found a couple of people who had been laid off, but there's clearly been layoffs in the tech sector that we've covered heavily here at Bloomberg. There's clearly been layoffs in the mortgage industry. Someone like Lori Bloomstein, who was forced into retirement in Florida, who features in our story, who is a victim of essentially the end of an era of easy money. There are people in manufacturing who have started to lose their jobs in recent months. So it's yes, the aggregate picture is still incredibly strong and resilient. And that, in the end, may be what takes Joe Biden over the line in 2024. But at the same time, you can't just, and we heard this from Jared Bernstein, the head of the Council of Economic Advisors at the White House when we talked to him last week. He said, look, we understand that people aren't feeling so great about the economy, and we're not here to tell them that everything is great in the economy. We understand that there's pain there, but we clearly have a sales job to do. And so, it's when we look at the economy, and I think this is true of markets as well as economists, we often look at the aggregate data. We often miss all the stories that are down there below that. And it's often those stories that are down there below that will impact on elections. Look at 2016. The economy looked to be doing incredibly well in 2016, and yet we know that a lot of people didn't feel that way about the economy and ended up electing Donald Trump.
All right, Sean, thanks so much for joining us. Sean Donnan, they are senior economics reporter for Bloomberg News, joining us on Zoom out of Washington, D.C. By the way, that Big Take story is also the subject of today's Big Take podcast. And you can find that on Bloomberg.com or wherever you get your podcasts. Don't miss the Big Take as well on Bloomberg Radio. That's weeknights at 11 p.m. Wall Street time. So we're going to talk a little bit more about this in a sense, Jess, when we talk a little bit later on in the program with Josh Green. He wrote a story about the student loan forgiveness that President Biden wanted to push through. The Supreme Court said, no way, Jose, but some are arguing he still needs to be on that. Let's get a check on the latest world and national news. For that, we go to Nancy Lyons in the Bloomberg 99.1 newsroom. Nancy?
Thanks, Matt. Treasury Secretary Janet Yellen is on her way to China for a 4-day trip aimed at finding some common economic ground. It comes days after China imposed new restrictions on 2 metals that are key to the tech industry. Secretary Yellen will arrive 5 years to the day of the first Trump-era tariffs on Chinese goods, duties that the Biden administration has kept in place. Greg Valliere, Chief U.S. Policy Strategist at AGF Investments.
I still think the biggest problem of all is chips. Computer chips is a big issue. The U.S. has not relented. We still haven't relented on the Donald Trump tariffs. So I think the chips issue may be the biggest of all.
Greg Valliere with AGF Investments. Ukraine and Russia are trading accusations over the threat of an attack on the Russian-occupied Zaporizhzhia nuclear power plant. Ukrainian President Volodymyr Zelensky is warning Russia may be planning to sabotage the plant in the country's south. He says they have intelligence that Russian troops have placed objects resembling explosives on the roof of several power units at the plant. Today, the Kremlin said it is Kyiv that's planning a provocation. Well, President Biden is not giving up on student debt relief, but as Bloomberg's Nathan Hager reports, his new plan is likely to face a new wave of legal challenges.
The president called his plan legally sound when he announced it hours after the Supreme Court rejected his initial attempt to forgive loans for millions of student borrowers. Even in a best-case scenario, though, the new plan couldn't be rolled out for at least another 4 months, and legal experts say it could face the same claims of executive overreach since it relies on authority from the Higher Education Act. In his ruling against the initial debt relief, Chief Justice John Roberts said that law could be used to reduce debt only under limited circumstances. In Washington, I'm Nathan Hager, Bloomberg Radio.
Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries.
Facts, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 3:40 on Wall Street. We do check markets all day long at Bloomberg. We have got the Dow, the S&P, NASDAQ trading lower. However, the NASDAQ 100 index is in the green. Let's head right over to the first word breaking news desk for today's afternoon call. Here he is, Bill Maloney.
And good afternoon, Charlie. U.S. stocks in the red, but well off their session lows. Dow's still down 118 points. S&Ps are down by 5, and NASDAQ declines by 6. The U.S. 10-year yield at 3.94%. Gold is down 9. Oil is climbing. And Bitcoin is down by 1%. Among the main 11 S&P sectors, leaders were utilities and telecom. Energy and materials were under pressure. And leaders to the upside in the Dow, Salesforce and Boeing, while Intel, Nike, and Dow Inc. each fell 2% and led to the downside. Regarding the Fed minutes, the Fed said almost all officials expected more rate increases in 2023. And in other news, Transport Knight Swift reported they see Q2 results lower than previously expected. Wrapping things up, Facebook gained as much as 3.5% as the company is expected to launch their Twitter competitor this week. Live from the first breaking news desk, I'm Bill Maloney. Charlie?
Okay, we thank you very much, Bill Maloney. And to hear live breaking news over your Bloomberg, type Squawk, SQUA on your Bloomberg terminal. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive. It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, Matt Miller. I mean, we're coming off one of the best first half to a year ever for the NASDAQ 100. And now a lot of portfolio managers in particular are trying to figure out how do we position in the second half of the year if they were maybe too defensively positioned. And so I want to...
It is, by the way, the best first half.
Yes.
Ever for the NASDAQ 100.
It is, yeah. It was.
Yeah.
And then the S&P 500 not doing too shabby either with double-digit gains so far this year. But I want to get straight to our next guest, David Dietz, who's Managing Principal and Senior Investment Strategist at PPAC Private Wealth Management, who's joining us on the phone in Summit, New Jersey. David, I want to just kind of take a step back and kind of get your take on the rally this year and how you're thinking about positioning for your clients in the second half of the year.
Well, in a way, it's been an eye-popping rally here, as you pointed out. Best first half for the regular NASDAQ since 1983, 16% of the S&P 500. That made almost every strategist kind of look a little foolish because everyone was very cautious about this year. In fact, most predicted a recession, and the recession is nowhere to be seen. So, where does that leave us? Well, the fact of the matter is valuations are now stretched here. And we're still grappling with inflation. We're still grappling with a Fed which does not know when it's going to stop. And, of course, recession fears are still lurking out there. In fact, they may even be heightened based on news we just got in the last couple of days from the second largest economy, China. So, it's not easy out there.
Yeah, well, we could be in a recession right now, for all we know, but it would be a very job-full recession, right? What do you think about this labor market, David?
Well, we're going to learn a lot more on Friday. Certainly, the job creation has started to slow, but still, with a 3 handle on that unemployment rate, it's hard to say that we got any kind of a problem with jobs. Having said that, of course, a lot of the new job creation is in the service sector and, quite frankly, the lower paying jobs as people get out of their house still in this post-pandemic world and want to go to the bars and travel and so forth. And there is pressure going on in financial services, for example, where the job creation is slower. And those are some of the better paying jobs. Obviously, all eyes by the Fed are on that job number. It's going to be very hard for them to continue this rate hiking if we see material weakness in jobs. It's something investors have to watch for.
With these different cross currents going on, how are you specifically telling your clients to position in their portfolios?
Well, I do think that bonds still make sense here. Well, they make a lot more sense than they did a year ago. And what's real interesting here, Jess, is that the real yields continue to widen. What are the real yields? Those are the yields that we see printed in the Wall Street Journal every day, less what inflation is. And to the extent inflation is coming down a little bit, and we're starting to see, well, the 10-year is knocking on 4% almost, that means real yields are increasing. Well, that's great for bond investors because historically those real yields will tend to contract as we go forward here. But it may be difficult for companies, right? Because a lot of companies are very indebted. They're going to have to roll over that debt. It's going to be difficult. So what I'm telling investors now is get back to your long-term disciplined asset allocation. Take some profits from a great first half and add those into better yielding fixed income.
Let's talk about stocks you like, David. You always include a few picks for us. And Bank America is one that just passed the stress test, and I guess they're going to be able to pay out more to investors. What's your take on BAC?
I think you got an opportunity here. This stock is down about 25% since February, while the S&P 500 has done nothing but go north. It's right now trading at just 90% of book value. Typically, it's about 20% above book value. Now, remember, this is one of your best positioned banks in the country. It's the second largest, coast to coast. You don't have too much international exposure, but it's still listed as a so-called globally important bank. I think the problem is that as interest rates have moved up, the value of their bonds in the portfolio, the mark-to-market value has moved down, but they intend to hold most of them to maturity. So I think people are being overly cautious. And remember, this is a bank where you're not going to be moving your deposits because you're afraid of the stability. That's the smaller and regional bank problem, not a Bank of America problem. So I would take advantage of it, this bank selling for less than liquidation value and hop in. I do think that if interest rates start to come down, and eventually they will, I think people are going to come back to the banks because there's less pressure on what they have to pay for deposits, less pressure on their portfolios. Bank of America is a winner.
One of the worst performing sectors over the last 12 to 18 months has actually been in the REIT space. What particular stocks are standing out to you that you think potentially could be a look here for some investors?
So we really like this Realty Income as an example. As you point out, the whole sector is down. So we're looking for some, so-called babies that perhaps have been tossed out with the bathwater. Why Realty Income? We confess to having a soft heart for dividends. Realty Income is one of those dividend aristocrats that has increased their dividend for more than 25 years in a row. Now, right now, it's yielding over 5%. I look at that compared with, let's say, the 10-year Treasury, which is under 4%. I could have my clients invest in a 10-year Treasury, get under 4% for the next 10 years, or have something that starts well over 5%, increasing historically year by year by year. Now, of course, what's the risk? Well, they're focused on the retail sector, but they got 12,000 different properties, primarily in the United States, and they're in the service sector of real estate, which is less prone to being trumped by, for example, e-commerce and things like that. The credit rating of their tenants is very high, and also they're focusing on the so-called triple net lease, which means the tenant, not the Realty Income, has to cover changes in operating costs and taxes and whatnot. So we think that's a great conservative way. The stock is down about 25% from, let's say, last fall to take advantage of these nice dividends.
Just got about 30 seconds here. ExxonMobil is one of your picks as well, and they're in the news today for various reasons. They got the go-ahead in Guyana to sink some wells offshore. On the other hand, they're not paying their oil traders enough. Why do you like the stock?
First of all, it's one of these global integrated, so you're not just rolling the dice on upstream production and so forth. Yeah, Guyana, we think, is going to come on to production far sooner than the street had forecast. Plus, of course, we love the Permian, low cost, and the Dallas Fed's pointed out that the cost inflation in extracting oil there is going down. And also, there's this wild card where they're going to be able to use carbon dioxide, suck it out of the atmosphere, inject it into these wells, and that could be a lucrative area too.
All right, David Dietz, Managing Principal and Senior Investment Strategist at PPAC Private Wealth Management. This is Bloomberg.
company news headlines on Bloomberg Radio.
Bloomberg World Headquarters, I'm Charlie Pellet. Airline stocks are rebounding today after earlier losses following travel disruptions over the July 4th holiday weekend. Helene Becker is follows the airline industry for TD Cowen, and on Bloomberg Surveillance this morning, she told us there are a lot of things in the airline industry that are happening simultaneously.
The Secretary of Transportation asked the 4 big airlines serving the New York area, Delta, American United, and JetBlue, to cut their summer capacity by 10% because air traffic control is understaffed. And then you add to that winter or summer rather thunderstorms, and you have all the aircraft have to land, especially the ones coming in from overseas, and then nothing's taking off. So you get those issues with aircraft that can't find gates.
And you can hear more of the conversation on the Bloomberg Surveillance podcast. So you can download it wherever you get your podcasts. Among airline stocks, UAL, parent of United, up by 1%. American up 1.2%. Delta up 1.4%. Southwest Airlines up 0.8%. JetBlue rallying today by just about 4%. More than 3,000 UPS workers are closer to striking after the company failed to reach an agreement with the International Brotherhood of Teamsters. Talks ended this morning at 4 a.m. UPS down now by 2%. FedEx up by 2%. Those are our top company stories. This is Bloomberg.
This is Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio.
All right, Jess Minton and Matt Miller in the Interactive Brokers studio in New York, and taking a look at one of these stories, specifically about New York City crossing the terminal. Matt is looking at how, not surprisingly, New York City's unhealthy air is tied to fireworks and scorching weather. And so I don't know about you, but I feel like over the past month, especially, there was one day I left the office and I was trying to figure out, why does it smell like a bonfire?
Yeah, it was, well, first of all, it was the hottest day ever globally on Monday. Temperatures,
I believe it,
rose around the globe to the highest level that's ever been recorded in the history of the world. So on average, obviously, just 17 degrees centigrade. So it wasn't like, as hot as it was here in New York. But I guess the air quality issue, I had never thought about the fireworks, although I was watching on Monday night. We had a little fireworks display at our little community over the weekend, and I saw large plumes of smoke. But if breathing firework air is unhealthy, then I guess I'm going to be sick, because I don't want to do away with fireworks. I would prefer to do away with Canadian wildfires. That's also something that's a bit of a necessity, though.
No,
so I think we need to have more of a controlled burn up there. At least that's what I'm reading. In any case, here in Manhattan, conditions improved enough by 11 a.m. to reach moderate levels across most of the city. That's when I got out of the Metro North station at Grand Central and started walking around. But I guess we just need to get used to this kind of air quality.
And when it comes to the fireworks, I mean, I can speak being from Texas. There's definitely places you can drive off the side of the highway and you can go buy tons of fireworks. A lot of it's illegal.
All year round?
Yes. And not that I'm condoning or trying to tell people to go do that, but there are places that we would go and buy some around 4th of July. So that was something that I would always partake in when I was down there. It was lots of fun.
Yeah, fireworks are a lot of fun. I typically see them only, here in the U.S., only on the 4th of July. I lived in Berlin for the last 6 years.
That's right.
You have not seen anything until you've seen Berlin on New Year's Eve. It is like a war zone, hopefully with far fewer injuries. It's just fireworks nonstop from about midday until 5 or 6 in the morning. I highly recommend anybody checking out Germany go to Berlin for New Year's Eve. We're going to come back and talk to our colleagues on TV. This is Bloomberg.
On the bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
About 2 minutes away from the end of the trading day and the closing bells, I'm Scarlett Fu here with Katie Greifeld, and we are counting you down to the closing bell. And as always, here to help take us beyond the bell with the global simulcast, we're joined now by Jess Menton and Matt Miller. And of course, in doing so, we bring together Bloomberg across our platforms, television, radio, YouTube audiences worldwide. Let's parse through some of the day here, guys. And Jess, I'm not sure that there's a lot to parse through because it feels like we're just kind of sitting around waiting. It's a waiting game right now until the jobs number on Friday.
It really is. And just looking where the S&P 500 is about to close, basically virtually unchanged. But looking at where it's currently trading at around 44, 48 almost, I mean, this is still relatively, and Matt and I have been talking about this, well above where these median price targets and the average price target is when it comes to Wall Street strategists being right below 4,100.
Yeah, I think we could have taken today off and tomorrow as well. I have a really cool interview that I don't want to miss tomorrow, so I will come in regardless. But yeah, we're definitely sitting on our hands until the Fed because we need to see what the deal is with the labor market before we can assess what the Fed's going to do next. Even after the minutes, we didn't really get much of a look other than pay attention to jobs, right?
Yeah.
If joblessness starts to really rise, then the Fed's going to have a much tougher time raising rates. On the other hand, if we beat again for the 15th month in a row on payrolls, then they're going to be able to raise 2 or 3 more times.
All right, and we're getting ready for the closing bells here. Just looking at volume, it's picked up from Monday, which is not saying a lot given that Monday was a half day of trading, but it is below the average right now, about 9.4 billion shares, according to NVOL USC, which compiles a bunch of different shares. I might have that billion wrong there, but in any case, you have the major indexes closing down marginally. The Dow Industrial is the worst performer of the lot, losing 0.4%, and the S&P 500 losing 0.2%. The Nasdaq was teetering between gains and losses, but it has picked a side, and it too is closing down. This is the first drop in 4 days, Jess.
Right, and looking at what's happening with the breadth underneath the surface here for the S&P 500, about 174 companies higher, but if you want to look at the decliners, about 326 today.
Do you look at MVOL?
Right.
Or do you look at AVAT?
I look at AVAT for volume, but then there's also the ARMS index for TRIN, which is another good one for volume.
All right, I always like to get people's functions of choice. Take a look at GRR. That's the group ranked returns on SPXL1 index, and you can see that we're still looking at some defensive purchases here, right? Utilities are rising. Real estate, interestingly, is a gainer today, and communication services is the biggest winner. That's because it's being powered high by companies that you probably would think go in the IT group. Meta, for example, as Scarlett was showing you last time. Google is also a big gainer in communication services, and that's driving that index higher. We have 4 groups higher. That means 7 groups are lower. Materials, industrials, and IT are the biggest losers of the day, although other than materials, you don't really see big drops.
And I'm taking a look at the gainers, Matt. So taking a look at what's happening with Moderna, that stock closing up more than 1%. So the drug maker did reach an agreement to produce mRNA vaccines in China. Another one, though, chip maker Wolfspeed. So this is a company with a market cap of around $8 billion, but that stock rallying about 11% today. It was actually its best day since November. So this company did announce that it did sign a decade-long supply deal with Renesas Electronics, and basically to supply these silicon carbide bare wafers for about $2 billion. And then lastly, just for Matt, taking a look at what's happening with General Motors, ticker symbol GM. That's up about 1%, of course. So the automaker did climb about 1% after it did say that U.S. sales did jump by nearly 19% in the second quarter.
All right, I'm going to give a shout out to Carol Masser, who always takes a look at Chinese companies traded in the U.S. This is the ETF that tracks Chinese companies, big cap China names, and FXI is down about 1% right now after China's economy showed some new signs of weakness, right? You had the Caixin China Services PMI. It came in above 50, which signals growth, but it did slow down and slowed to the slowest rate since January. So that's certainly a concern, especially because the reopening of China was supposed to be this big trade for 2023 that clearly has not panned out. I'm also looking at UPS losing 2% after the latest round of talks ended nowhere. They still have until July July 31st to come together on something, but right now the talks between the UPS, the Teamsters and UPS have not yielded very much, and now as a result you have more than 300,000 UPS workers closer to striking.
Well, speaking of yielding, Scarlett, let's get over to the bond market because it was a sell-off across the board. And it was interesting. You actually saw more movement at the long end of the curve. You can see 2-year Treasury yields pretty much unchanged. Then you get out to the 10-year space. Yields up about 8 basis points or so, and then 20 years up 7 basis points as well. That's actually re-steepening the 2s10s curve a little bit, but we're still talking about negative 101 when it comes to that inversion. And in terms of the reaction to the Fed minutes, we didn't really see too much. The move started earlier in the day and sort of yields ground higher from there. A lot of that had to do with basically the Bank of England rate hike premium being built in, people betting more that we could see more from the Bank of England after we heard from a JP Morgan economist basically saying so, which gets to an interesting conversation about these central banks. The Fed has been leading the way on the hawkish side, but maybe that baton is ready to be passed off.
Yeah, I wonder how much groupthink there is among central banks around the world. Clearly, the U.S. is in the lead here because it moved quickly when it came to, finally, to addressing inflation and raising interest rates, whereas the other central banks kind of had some time. But now you're starting to see a lot of hawkish talk from the ECB and BOE continued on that front.
None of that seems to bother tech investors in the U.S., though. You know, the group on the S&P, the tech group is up about 41% year to date. And of course, as Jess and I, well, as all of us were talking about last week, the NASDAQ had its best first half of all time. So even as those rates rise, it hasn't deterred investors from buying tech stocks, and especially those mega cap stocks that just continue to get bigger and bigger and bigger. Although I will note that I think Apple is the biggest point reducer on the S&P 500 today.
I actually checked that stat. Even though Apple shares are only off like 0.6%, it's just so massive that its contribution to the index is overwhelming.
But I mean, the big gainer for today, or the one that we're paying attention to, is Meta because of the eve of its debut of Threads, which, Katie,
so psyched.
You're really into this, right?
I'm really into it. It's sort of like this social media arms race that's going on. You have, you know, Meta, sort of the incumbent in the social media landscape, coming in, trying to steal Twitter's lunch here. But then you have the upstarts such as Blue Sky, such as Mastodon. I don't know who wins.
And something else I was taking a look at, because Savita Subramanian on Tuesdays, actually this comes out once a month. She has this sell side indicator, which basically is a contrarian indicator when you're looking at positioning when it comes amongst these Wall Street strategists. So on average, the allocation to stocks, you saw a bit of improvement when it came to sentiment, but in general, it's still hovering around a 6-month low, despite improving a little bit over the past months. So I know we talk a lot about some of these sentiment measures, whether it's AAII or consumer confidence or maybe University of Michigan, but we've seen it improve. But again, it hasn't come off of some of those extremes that we obviously have seen over the past year.
All right. Well, thank you all for joining us. I say that to you as well as our viewers and listeners. That does it for our cross-platform coverage of the market close on Bloomberg Television, on radio, YouTube, and on Bloomberg Originals. We'll see you back here at 3 p.m. tomorrow. It was a 4-day weekend. I know that you and Paul were both working.
We were here.
But a lot of people wanted to take advantage of the time and go somewhere. Maybe not necessarily revenge travel, but, you know, back to life as usual. And they were deterred, foiled by the airlines, or maybe by the FAA, or maybe by the weather, depending on who you listen to. In any case, so many flights were canceled and vacations ruined that we wanted to get to the bottom of it and see what's wrong. George Ferguson joins us. He's our senior aerospace, defense, and airlines analyst from Bloomberg Intelligence. He's at our BI headquarters in Princeton, New Jersey. And Elaine Becker joins us as well, managing director and senior research analyst over at TD Cowen. She joins us on Zoom from New York City. Helene, let me start with you and ask, you know, what happened over the weekend? Does United have a problem, as Pete Buttigieg suggested? Were the weather delays the issue? Do we need a revamp of the entire system?
How about all of the above?
Yes.
So we've talked about this before. We've been alerting people to the fact that we don't have enough air traffic controllers and haven't for quite some time, and it's going to get worse before it gets better. During the pandemic, this is amazing to me, but in the 18 months where the pandemic was at its worst, the US government did not train a single air traffic controller. And you have at least 400 to 500 of them retiring every year in this decade. And they were not able to hire this year their full complement of 1,500. They were not even able to find 1,000. And something around 300 to 400 don't make it through the full 3 to 6 year program. And then when you get to New York, and it's not only New York, it just that many of us live here and we bear the brunt of it, but it's New York, Chicago, Miami, LA. These cities are expensive to live in, and top air traffic controllers earn in the $180,000 a year range, and they don't have the ability to live here because we live in such an expensive area. So when they're offered the opportunity to come here, they say no. So the Newark Air Traffic Control Tower is 54% understaffed.
Unbelievable.
And when you do them, I know, right? And when you do the math, so you hire 1,000, you wash out 500, you have 500, you're short 3,000. According to the secretary, we were supposed to have 14,000 and we have 11. And he asked the 4 big airlines serving New York, that would be United, American, Delta, and JetBlue, to cut their summer capacity by 10%. But his employees, the air traffic controllers that are supposed to staff the towers, will call in sick from time to time. I mean, everybody gets sick. The way the airlines have handled that is to offer as much as triple pay for flight attendants, mechanics, pilots, and so on, to pick up that time during holidays. Because, of course, everybody wants to spend holidays with family, but people are flying. Yesterday, 2 million people flew.
Well,
Right.
Well, they
Right,
honestly they need
so-
to revamp that system, because you can't pay an air traffic controller who works at CMH the same as an air traffic controller that works at JFK. It just doesn't make any sense at all.
Exactly.
And hopefully, we have, I guess, what's supposed to be a progressive government in place. They should make those changes. George, what do you think about the airlines? Because Buttigieg says United has some internal issues, and we also see that they are in a little bit of a spat about slots at Newark. So are the airlines giving it their best shot here?
I do think they're giving it their best shot, but like Helene said, it's all the above. It includes the airlines. They've had a lot of turnover in personnel. I think they've done a great job trying to hire backfill after the pandemic, but they have to train all those people to get to the throughput that we had in 2019, or levels of productivity around that 2019 time frame. That's hard. That takes time. And I think United was especially sort of put at a disadvantage this weekend, as weather was kind of extraordinarily bad going into the weekend. And I live in New Jersey, haven't seen rainstorms come through in successive days like that. And we know Newark is not good, even with bad weather, let alone missing controllers in the tower, as Helene was relating. So I think United kind of got a bit hamstrung going into the weekend from some pretty bad weather at one of its most important hubs.
Right. And you were talking about, obviously, these issues with United. Which airlines have been able to mitigate these issues better?
I don't think that any of them have been able to mitigate them any better than any others. They all have their sort of time in the spotlight when they have a problem like this. Again, United, particularly Newark's really important to them, and Newark is a very, very busy airport all day long. So when you back things up at Newark, and it's an important part of your schedule, you have planes all out of where they need to be around the country, and it gets really hard to recover. It takes days to recover from that. Pilots overtime on that, right? Because they spend more time flying on delays or stuck on the ground, and then you can't use them. So it creates major ripple effects.
Helene, what do you think about this industry in terms of investability? There were many, many years where I had no idea why investors would want to buy airline shares at all. There were decades where prices didn't change. I would fly out. I always tell people to see the Grateful Dead in the 90s on the West Coast, and the ticket cost me the same as it cost me to fly out and see the Grateful Dead in 2015 on the West Coast. Now we've seen a little bit of pricing power, but what's the argument for investing in these airlines?
Well, I think to have a successful and robust economy, we need a successful and robust airline industry. That is incredibly important. I think George started to talk about this. I've talked about this as well. We have infrastructure issues. There's no place to add a third runway, a third parallel runway at Newark, right? On one side of the airport, you have Route 1. On the other side of the airport, you have the Jersey Turnpike. So you're not expanding Newark. And that's the case at many airports around the country. So we have infrastructure issues that are exacerbated by exogenous events that nobody can control, weather, pandemics, things like that being just two of them. But I think we think the industry has become investable. The issues that the industry is having leads to higher ticket prices. And to your point, after many years of deflation in the aviation industry, we have a better environment for pricing. We finally, to what you said, we finally have some pricing power, and that's part of that is the fact that wage rates have gone up, fuel costs have mitigated a little bit from the highs of 2022, and airport fees have started to stabilize. Maintenance costs are starting to come down as delivery delays abate, although most of the aircraft that were supposed to have been built over the last 4 or 5 years will never be built because they just kept getting delayed to the right. So you put all that together and it leads to higher costs, but then everybody's experiencing the same inflationary cost pressure. So everybody's raising ticket prices, even the ultra low cost airlines are raising their ticket prices. So that's a good event from an investing perspective.
Yep.
So George, what does this mean we have earnings season coming up. We're actually going to have Delta reporting earnings next Thursday. We actually did hear from them recently talking about how they were already expecting a higher profit outlook just given the summer travel demand. Is that going to be more exclusive to certain airlines, or do you think this is going to be more broad-based?
Yeah, so we've got our previews out in the Bloomberg terminal, and so what we've seen as we've looked through the financials is we think the full service airlines, like United, American, and Delta, will see probably some very nice earnings performance this quarter. We think one of the drivers of that is overseas demand, demand to travel overseas, right? Europe is very, very hot this summer. And so ticket prices are strong there. We've seen a bit of weakening in domestic ticket prices. And so we think while they'll still have a nice earnings season, it won't be as good the more the airline is concentrated on the U.S. domestic market, Southwest, Spirits, the ultra low cost. They all have a little bit of international, but the more focused you are on domestic, I think it won't be as good an earnings season for you.
Helene, just got about 30 seconds here. Do you have any favorite picks in the airline industry?
To George's point, because international demand is so strong, United, Delta, and Copa Airlines are our top 3 picks.
Awesome. All right. Well, thanks so much for joining us. Really appreciate getting you. I know, Helene, we had you on this morning as well. So doing double duty. Helene Becker joining us there from TD Cowen, and George Ferguson. Appreciate you joining us as well from our Bloomberg Intelligence headquarters there in Princeton. And as he said, you can get the previews from Bloomberg Intelligence. They're already out on the terminal. You just type BIGO and navigate into George's universe there to find out what he likes in terms of airlines. And hopefully next time we have a holiday weekend, you can glean some info there for better picks. This is Bloomberg.
events, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 4:21 on Wall Street. When we do check markets all day long at Bloomberg, we begin with a developing story and a headline from the Bloomberg Professional Service. JetBlue has decided not to appeal a court's ruling against the Northeast Alliance with American Airlines and has initiated the termination of the alliance. JetBlue says it will now turn more focus to its proposed deal with Spirit Airlines. Stocks move lower today. The Dow, the S&P, and NASDAQ all declined. Yields on treasuries climbed. Stocks slipped as traders digested commentary from Federal Reserve officials last meeting. The FOMC minutes today, S&P down 8 points, a drop there of just about 0.2%. Dow Jones Industrial Average down 129 points, a decline there of 0.4%. NASDAQ down 25, a drop of 0.2%. The NASDAQ 100 index, little change, but still down by about 4 points, down less than 0.1%. 10-year yield, 3.92%, with a 2-year 4.94%. Gold down $9.50 the ounce to $19.15, drop there of 0.5%, while West Texas Intermediate crude oil rallied 3%, $71.90 for a barrel of WTI. Again, recapping, stocks lower, S&P down 9, a drop of 0.2%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you, Charlie. We appreciate it. Jess Mitten and Matt Miller here in the Interactive Broker Studio in New York. And going straight to our next guest, who's Kevin Carter, founder of EMQQ. This is an emerging markets, internet, and e-commerce ETFs. He's joining us on Zoom in London. Thank you so much for joining us, Kevin. Talk to us about your ETF. And
wait a second. Are you in the bathroom at Annabelle's?
Oh, I'm just in this back room now.
No, I am in my hotel room in London.
I like that.
It's snazzy. That's why
I was going to go upstairs, but there was a Bloomberg conference that had the space taken.
All right, so Kevin Carter, live from the NED. Appreciate you joining us. Let's talk about EMQQ. I mean, emerging markets is hot right now. And India has been the story really for the last 6 months, maybe the last year, as we, I guess, decouple or de-risk, diversify, however you want to put it, away from China. India is the place to go.
Well, you said it very well, by the way. Whatever you want to call it, let's do more stuff with people like India instead of China. That's definitely a part of the India story. But the India story, it's incredibly compelling. I mean, in many ways, you could think of it as the perfect emerging market at the perfect time. And what I mean is that, the promise of emerging markets has always been this, great growth story. You have billions of people, their GDPs are growing faster, their incomes are going up, and they want to buy stuff. They want more and better food, clothing, appliances, vacations, you name it. And that's the story. And if you're going to invest in emerging markets, that's been the story for a long time. But what's happening in India right now, you have the biggest population on the planet. They've just passed China. It's very young. They have a population that's at least 10 years younger than China's on average. They have the fastest growing economy, the fastest growing e-commerce market, and they have a government that's very not just supportive of, but pushing digitalization, and that's driving, I think, what's going to be a 10-year boom in emerging markets and specifically Indian internet companies.
And especially when we think about some of these big tech type names, Apple comes to mind when you think about companies like this that are adding that exposure toward India. What is it that is more specifically when it comes to some of these bigger players that really has brought them in?
Well, I think, Apple's there obviously on the product side to sell to the 1 billion Indian consumers who most of them they can't afford an iPhone. So the Apple iPhones are a very small, part of the smartphone market. It's a very big part of the the resale market, second phones. And Apple's also brought manufacturing to China. And so Apple's really, if you think about Apple as example of a lot of things in our lives, but as an example of what's happening in India, they're bringing manufacturing. They're expecting to have about 25% of their phones made in India by the end of 2025. They're trying to go after the India, smartphone user. But it's a very premium product, especially for the Indian market, which is very price conscious. And I don't know if you've seen this news, but Reliance Industries, Jio, announced. I haven't had a chance to read the full story because I was on a flight here, but they just launched a $12 smartphone in India, which obviously is not an Apple phone. It's on Android. So most of the emerging markets are on Android.
Yeah, absolutely. We have the story up on the Bloomberg terminal here, Kevin. In terms of the economy there growing so that people can afford to move up from a Reliance Android phone to an Apple phone if they want. Maybe people don't love, not universally, the Apple iOS, but is there going to be a middle class creation in India, the likes of which we saw in China? And do you expect it to be at the same pace or maybe even faster?
Well, I mean, it's already happening. They have a very big and growing middle class. And that consumption in India is expected to pass China in the next 10 years. So, yes, that's absolutely part of the story. And yes, Apple's an aspirational brand. Again, the largest market share of the secondhand phones is Apple phones getting recycled in China. So, or in India, rather. So the India story, it's incredibly compelling. And I've been involved with emerging markets for 18 years. I've started in China, and with India, it feels a lot like China did 17 years ago, but with a number of differences and advantages, including the fact that the smartphone, the computer, if you will, because ultimately the smartphone is the computer for the developing world. Everything's in a sweet spot for India, and I think it really is almost certain to be a decade or 2 decades, probably, of really incredible growth. And then the key is trying to capture that growth, because the problem, if you'd invested in China 15 years ago, before the economy grew 400%, and you bought the traditional index, you have an economy that went up 400%. But if you bought the China index or the China ETF, you were down 50%. So I think it's key to recognize that, yes, India is going to grow, and it's almost certainly going to grow a lot and be very big, but you've got to find the right ways to invest in that. And I believe very strongly that the Indian internet companies, just as we saw the FANG stocks take over our lives, just as we saw Alibaba and Tencent dominate the China internet, the China consumption market, now the Indian internet companies seem poised to do that. And you get that exposure through EMQQ, but we've also made INQQ, which is an India-only focused strategy, which I think long-term investors should be very interested in.
By the way, I wonder, you mentioned your experience with emerging markets goes back, and of course you have launched in the past IPOs with Guggenheim, EM-focused IPOs. What's the best way to do emerging markets surveillance? I mean, what do you watch? What do you read? How do you get the data that's so necessary to play in those markets? It seems like an opaque market to a lot of Americans just because it's so far away and we don't get that news on the front page.
Okay, that's a great question. First of all, your firm does actually a pretty good job at covering the bigger companies in the space. I would recommend there's a great website. It's a not-for-profit website that has devoted a lot of money to making sure that the emerging market tech story gets a lot of coverage. It's called Rest of World, restofworld.org, which was actually founded and funded by Sophie Schmidt, Eric Schmidt from Google's daughter. I think that might be the best source of non-biased coverage of the emerging market space, and thus the emerging markets internet space. Because the reality is, in India and all of the other emerging markets, they're actually ending up more digital than we are, because as they're becoming consumers, they don't have bank accounts, they don't have cars, there's no Target store. And so all of these billions of new consumers, especially in India, are leapfrogging traditional consumption and going online. And I think Sophie's organization, Rest of World, does a great job of covering what's happening there in a very balanced way. Because the reality is that, the smartphone brings the computer and it brings to the internet to these people for the first time. And because they've had such a lack of access to financial services, information, it's hard to explain, but we had a very progressive evolutionary experience with technology and information on the internet. These people are going from nothing to everything overnight, and it's not all good. Certainly there's a lot of growth and investment opportunity, but there are fake news and other things that can cause challenges to these parts of the world.
Right. Well, thank you so much, Kevin, for joining us and giving us this purview, obviously, when we're talking about India, as well as some of this exposure when it comes to your ETF. That's Kevin Carter, founder of EMQQ on Zoom, joining us in London from there. Thank you so much. We appreciate your time. And Matt, I was taking a look at some of the names in his ETF, and JD.com down about close to 40% this year. And if you want to look at Alibaba, it's actually down about 8% as well. So some of these e-commerce names taking a bit of a hit there compared to some of these other tech corners of the market.
Yeah, the question is that a better choice than buying the bloated and overpriced names that we have here? That's why a lot of people like EM. We'll talk more about it. This is Bloomberg. Right now, I want to get a check at the latest world national news. For that, we go to Nancy Lyons in the 99.1 newsroom. Nancy?
Thanks, Matt. Ukraine and Russia are trading accusations that they each could be planning an attack at Europe's largest nuclear plant. We get more from Bloomberg's Nathan Hager.
Russia has occupied the Zaporizhia nuclear plant in southern Ukraine since the start of the war. Overnight, Ukrainian President Volodymyr Zelensky warned in his nightly address that Russian troops have been seen placing objects that look like explosives on the roofs of several units at Zaporizhia. He says the Kremlin could use them to simulate an attack. Russia, meanwhile, is accusing Kiev of planning a provocation. The UN's nuclear watchdog says it's monitoring the situation, but sees no evidence of anti-personnel mines on the grounds of the plant. In Washington, I'm Nathan Hager, Bloomberg Radio.
The Southwest Philadelphia community that was the site of a mass shooting Monday night is reeling after 5 people died and 4 were injured. The suspect was arraigned this morning and is facing multiple counts of murder and attempted murder. Philadelphia District Attorney Larry Krasner says they're providing resources to help those impacted.
The bullets don't care, but we do. And I know the rest of this city does, and I know the rest of this country does.
Krasner says they're still trying to determine what motivated the suspect to carry out the attack. Yusuf Salam, one of the exonerated Central Park Five, has won a Democratic primary for a seat on the New York City Council. It's an improbable feat for a political novice who was wrongly accused, convicted, and then imprisoned as a teen for the rape and beating of a white jogger in Central Park. He served nearly 7 years in prison before the group was exonerated through DNA evidence. And former New York Mayor Bill de Blasio and his wife, Charlene McRae, are separating, but the New York Times reports they are not divorcing, but will date other people. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. This is Bloomberg.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 4:40 on Wall Street. We do check markets all day long here at Bloomberg. JetBlue will not be appealing a federal judge's ruling that declared its alliance with American Airlines violated antitrust law and will instead focus on defeating a similar challenge to its pending merger with Spirit Airlines. Yields on Treasuries climbed, stocks slipped as traders digested commentary from Fed officials in their last meeting. S&P today down 0.2% following the release of the minutes of the Fed's June meeting, which indicated hawkish leanings from some voting members. The Dow is down 129 points today, a decline of just about 0.2%. Nasdaq down 25, a drop there of 0.2%. Russell 2000 index of small cap shares down 1.3%. 10-year yield 3.93% with a 2-year that's yielding 4.94%. Gold 19.15 the ounce, down by about 0.5%. West Texas Intermediate crude oil rallied 3% today, 71.90 for a barrel of WTI. Rivian Automotive has started delivering the electric vans it makes for Amazon to Europe in the EV maker's first commercial shipments outside of the United States. Rivian up for a 6-day today, up 4.5%. Amazon was up by 0.1%. Municipal bonds sold for Elvis Presley's Graceland tourist attraction have fallen deeper into distress. U.S. Bank, the trustee on the debt, disclosed it could not make July 1st principal and interest payments. Recapping, stocks lower, S&P down 8, a drop there of 0.2%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Charlie, thanks very much for that. Charlie Pellet there with your Bloomberg Business Flash. Matt Miller here in the Bloomberg Interactive Broker Studio at Jess Menton. We are always so focused on New York City. Occasionally, we look at London or LA, but I want to get back to the heart of it all right now. Let's get to the great state of Ohio. Andrew Ginther, the mayor of Columbus, joins us on Bloomberg Business Week. Mr. Mayor, pleasure to have you on the program. I'm sure you know that I am an Ohio boy, a product of Grants Hospital there in your great city, and my heart will never leave. I've been reading a lot about the transformation of the Midwest and how Ohio is at the heart of it all. A lot of people find it very interesting, but to me it's obvious. I get it. Walk our listeners, though, through why Columbus, Ohio is such a vibrant, dynamic place for business and for the economy.
Well, thanks so much for having me. Great to be back with you, and love to share what great things are happening here in Columbus. We really think one of our great advantages here in our community is certainly our people. But also our commitment to the Columbus way. We think we do public-private partnerships better here in Columbus and Central Ohio than anywhere in America. And so you take a look at our work around neighborhood redevelopment, workforce development, downtown revitalization. It involves the public and the private sector working together with philanthropic and higher education partners to really improve our quality of life, grow the winner's circle, and do all of our work through that lens of equity. And it's why we're so excited to celebrate great wins with Intel and Honda and IG and so many great companies that are growing, expanding, or relocating here to Central Ohio.
Talk to us about these new initiatives that you've launched when you're looking at the Columbus region and how this has really helped this land in the top 5 for when you're thinking about this downtown recovery process post-pandemic.
Yeah, we're really excited. Downtown is everybody's neighborhood. It's also the economic engine for the entire region. I remind folks that folks working downtown help to pay for basic city services in neighborhoods throughout our city. But certainly over the last couple of years, our downtown has changed. And one of the reasons we're one of the fastest recovering downtowns in America is really having that balanced approach, wanting to continue to grow the number of residents downtown, but also making sure that our corporate and major office tenants downtown continue to feel safe, welcome, and have great entertainment, great amenities right here in downtown, free concerts in the Columbus Commons and festivals along the Scioto Mile, all public-private partnerships and investments that we've made in to make the amenities downtown top rate as well. We also have a big focus on housing and making sure that regardless of what you do for a living, we believe everybody that works in our region should be able to afford to live here too. So in addition to some great luxury apartments and condominiums and homes in downtown, we're also putting a new focus on affordable housing. So if you're sweeping the floor at that great hospital where you were born, Matt, there's a place for you in downtown as well. Folks that teach our children, that take care of our parents, as well as CEOs and business leaders. Everybody has a place for them downtown.
Yeah, I love it downtown, and we'll never forget growing up with visits to COSI and the Columbus Zoo. Don't forget where Jack Hanna's from. Of course, Ohio State, the Ohio State University is a key to that culture as well. But you mentioned, the newcomers with Honda and especially Intel. I was born and raised in Bexley and eventually moved out to Granville. And a lot of people, are moving out to the metropolitan area. How do you deal with that growing sprawl?
Well, it's really one of the reasons we've got to think differently about transit, about mobility and housing. You probably remember this, Matt. We haven't rewritten our zoning code in 70 years. Columbus was probably a city of about 375,000. We're now knocking on 1 million, and we're going to grow by a third in the city and in the region in the next 30 years. Some argue it'll be 20 now, based on some of the huge announcements that we've already mentioned. And so it's really important that we embrace height and density, as well as making our next steps forward. We'll be putting the Link Us Transit Initiative on the ballot before the voters in November of 2024. With a big focus on transit supportive infrastructure that'll be part of that as well. So it's really important that we think about the future and make investments in infrastructure and ourselves now, so that as we grow, we're able to remain competitive, affordable, and accessible for the best and the brightest, not just around the country, but the world.
I don't think a lot of people know really how diverse Columbus is. When I was a kid, I just sort of took it for granted that there were people of all different colors and races and religion around. And I remember coming to New York and thinking about how aggressive they were here. It was like aggressive diversity as opposed to the friendly diversity that we have back home. I wonder what it is that makes Ohio such a friendly culture to live and grow up in.
Well, we really think diversity is one of our greatest strengths here in Central Ohio. We have a 100% score from the Human Rights Campaign, ranked by BET as one of the best places for Black families to raise their children and do business. We think that diversity is a great strength, and obviously having the Ohio State University, Columbus State Community College, some of the greatest companies in the country and the world, having headquartered or huge presence here, they want the best of the best from around the state, the country, and the world. And we think a big part of that isn't just about economic growth, it's making sure that people feel safe, that they feel welcome, and they feel part of this community. And it's a place where over half the people that live here now were not born here. I'm in the minority being born and raised in Columbus. I imported my wife from Cincinnati. Over half the people that live here now were born somewhere else. And I think that also gives us a sense. I always say the sun is always rising in Columbus. We're continuing to grow, and we're one of those cities that's really on the move in the 21st century.
All right, Mr. Mayor, thanks so much for joining us. Really appreciate your time, and man, I wish I was home to get some Rubino's pizza and go across the street for some Grater's ice cream, because I sure do miss it. Andrew Ginther there, the mayor of Columbus, Ohio. Jess, you and I were talking earlier with David Dietz over at PPAC about his pick. He liked Bank America, and we were talking about the fact that they sailed through the stress test. Now we're getting headlines out on the stock, on the company.
Yeah, looking at this Bank of America to increase its quarterly dividend to 9% to about 24 cents per share, and this obviously coming on on the back of those Fed stress tests that we saw a little just earlier, about a week ago. And so looking at that and seeing it kind of following suit with some of these other big banks that are boosting those quarterly dividends.
All right, very interesting stuff. And we've already seen a couple of banks come out with dividend increase announcements at the end of last week, and we're sure to see more come out by the end of this week. This is Bloomberg.
Your company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. As we have been reporting, Bank of America plans to increase its quarterly stock dividend to 24 cents a share from 22 cents beginning in the third quarter. A downgrade today for Coinbase Global at Piper Sandler. Analyst Patrick Moley says the uncertainty surrounding Coinbase Global has made it too difficult to forecast how much revenue the company could own. Coinbase today down by 2%. Meta Platforms, the parent of Facebook, is expected to launch its Twitter-like Threads app this week. Some reports say tomorrow. Other reports say possibly as soon as today. The Instagram Threads countdown does show a release for today. Mandeep Singh of Bloomberg Intelligence says it could see some success.
My sense is, given what's going on with Twitter and, Twitter restricting the number of tweets people can have as unpaid users, it's a good time because you see so many other apps, Mastodon, Blue Sky, so it's up for grabs in terms of engagement, and I think Meta is best positioned to launch a product like this.
Threads will not be offered in the European Union as the company works out how data sharing between the new platform and its Instagram app will be regulated. American Equity Investment Life Holding did accept that $4.3 billion cash and stock takeover bid from an arm of Canadian investment giant Brookfield. Shares of American Equity up today by 2%. Those are our top company stories, and this is Bloomberg.
Charlie,
You're listening to Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio.
Jess Mitten and Matt Miller here.
Thanks, Charlie.
Interactive Broker Studio. Thank you, Charlie, as always. Charlie Pellet for the Bloomberg Business Flash update there. So we still have, it's been close to an hour now where the stock market's been closed, Matt. But before we get into more, let's throw it back to Nancy Lyons in the Bloomberg 99.1 newsroom in Washington, D.C. Nancy.
Thanks, Jess. The White House is not saying much about the discovery of a white powder at the White House that turned out to be cocaine. Press Secretary Karine Jean-Pierre took questions about it today.
We are not involved in this. This is something that the Secret Service handles. It's under their protocol, and they are going to investigate and get to the bottom of what happened this weekend, and we appreciate that.
Press Secretary Karine Jean-Pierre says the Bidens were not at the White House at the time. The Secret Service says the drug was found in a work area of the West Wing. The suspect in the mass shooting earlier this week in Philadelphia has been ordered held without bond. He appeared in court today and was charged with 5 counts of murder after surrendering to police. 4 others were injured. The suspect was found with a police scanner, an AR-style rifle, a 9mm handgun, and a bulletproof vest that was loaded with multiple magazines. A motive has not been determined. More than 300,000 United Parcel Service workers are planning to go on strike after the company failed to reach an agreement with the International Brotherhood of Teamsters. We get details now from Bloomberg's Amy Morris.
Weeks-long talks between UPS and the Teamsters fell apart early this morning in Washington after stretching through the July 4th holiday. Negotiators left the meeting just after 4 this morning to say the talks had collapsed. Teamsters say the company walked out. UPS is encouraging Teamsters to return to the table. There's still time to reach a deal. The current labor contract expires at the end of this month, but without a deal, union employees will not work after July 31st, and no more bargaining sessions are scheduled. In Washington, I'm Amy Morris, Bloomberg Radio.
New York Yankees right-hander Jimmy Cordero is being suspended for the rest of the season for domestic violence. MLB Commissioner Rob Manfred said the suspension is for violating the league's joint domestic violence, sexual assault, and child abuse policy. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. Now back to you, Jess and Matt.
Thank you, Nancy. We appreciate it. Jess Mitten, Matt Miller here in the Interactive Broker Studio. And Matt, Nancy was actually talking about this story on the terminal, looking at how the Secret Service confirming cocaine found in West Wing phone cubby. I know this is a story you were talking to me about earlier.
I thought last night I saw this story, and at that point we only had very limited detail. So we just knew that a white powder substance had been found in the White House, and it was confirmed to be cocaine. You know, there are obvious alarm bells that go off in your head, especially considering the president's family and history of addiction. But we now find out that it's in an area that a lot of tourists move through. And then the most important detail, I think, a phone cubby, right? So this is where tourists or visitors to the West Wing coming in are supposed to put their stuff and then move on.
So heavily traveled area.
Heavily traveled, and anybody obviously could have put it there. It's not as much fun when you think about it that way. Story, or maybe, thank goodness, it's unlikely to be someone who actually works or lives in the White House. But it's still just an amazing story, though, isn't it?
It really is. So right now, the agency is investigating how cocaine entered the White House complex. So we'll have to stay tuned to see what other news and developments we get out of this.
It seems like anyone just visiting the White House could have just had cocaine in his or her pocket next to the phone and, you know, put them both in the cubby. You know, it's not terribly unlikely that that's the way it got there. But they must have cameras, right? So the question is,
I would think there has to be.
Can they pinpoint the time and just look and see who put her or his phone in the
Right.
cubby at that point?
Yeah.
Or do they
we
not
gotta
care
get-
that much?
I mean, that could be it as well, but there's got to be some video footage on this.
Karine Jean-Pierre said the president thinks this is incredibly important to get to the bottom of.
Right.
So I guess they do care.
To taking it seriously.
This is Bloomberg.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenevec on Bloomberg Radio.
Jess Mitten, Matt Miller here, once again in the Bloomberg Interactive Broker Studio, filling in for Carol and Tim. And we still have an hour left to go, Matt, that I'm excited about. We have more guests coming up, including when we're looking at this story about the Democratic fight over the student loan forgiveness for BW Daily. We also